Okay, so let's pick back up here and go through different payment plans real quickly on the loan types, which are 286, 287 in your book. The most common is the fixed rate level payment, as we've talked about. Rate's fixed, does not change over the term of the loan. Payment stays the same. The only way the payment would change is if the escrows change. For example, if the taxes go up, then the amount they're collecting on a monthly basis for taxes would also go up. But the principal and interest payment with a fixed rate level payment loan would never change. We talked about term loans, interest only, never paying anything toward the premium, going to have a large balloon payment at the end. We also mentioned adjustable rate mortgages. The interest rate's going to adjust, and it can adjust either up or down. It's tied to some index rate. It'll be stated in the loan what an adjustable rate mortgage is tied to. Some are tied to the prime interest rate, for example. So if the prime interest rate were to go up, then the interest rate on the loan would go up. When you hear the phrase a 1-year ARM or a 3-year ARM, for example, that simply means that's how often the rate can change. A 3-year ARM would allow the rate to change once every 3 years. Most adjustable rate mortgages do have some kind of caps on how much the rate can change in each adjustment cycle. So the rate can change no more than a certain amount at each adjustment cycle. They also usually have what's called lifetime caps, that the rate can't change by more than
8%.
whatever it happens to be, 8%, 10%, 5% over the life of the loan. Okay? Those are the interest caps on ARMs. The initial rate on an adjustable rate mortgage is usually called a teaser rate. The teaser rate. Because it's lower than the market rate is at that point in time. That's the whole point of an adjustable rate mortgage in most cases. In most cases, people choose adjustable rates over fixed rates because the teaser rate is lower than what they could get on a fixed rate note. I mean, if you think about it, why would you get an adjustable rate that has the potential to go up if you could get a fixed rate for a lower amount? Okay? Now, one of the things you have to take into consideration there is interest rates aren't always what they appear. We're going to learn about something called the APR, the annual percentage rate, later on. That's different than the interest rate. The interest rate is very simple to understand. The APR is more complex. The APR actually takes into account all the fees you pay up front in addition to the actual interest you're paying on a monthly basis. There are cases where a loan with a lower interest rate actually ends up with a higher APR because of the fees associated with it. A classic example of that is an FHA loan. For example, you can go out and get an FHA loan now at an obscenely low 3.5%. But when you look at the APR of that loan, it's closer to 4.5%, 4.625%, because there's so many fees associated with an FHA loan that it jacks that rate way up. Okay? Most ARMs don't have a prepayment penalty, and some may allow them to be converted into fixed rate loans. Graduated payments are on a set schedule. The payment's going to go up year by year. Sometimes the payment can be less than interest only in the beginning, which can cause the principal to go up early on, and then the payment would graduate to a higher amount in order to satisfy the loan as you go on. Balloon payments we talked about, that's the amount remaining at the end of any term loan. A buy-down loan. Sometimes we call these a 3-2-1 buy-down. Builders use these a lot. A 3-2-1 buy-down is sort of like discount points. The difference is this. With discount points, the interest rate is being lowered for the entire life of the loan. With a buy-down, it's being lowered for a very short amount of time in order to make the property more affordable initially for the buyer. So in the case of the most common one, which is a 3-2-1 buy-down, in year one, the rate is bought down by 3%. So if normal market rates are 4%, what would your interest rate be in year one of a 3-2-1 buy down? It'd be 1, because it's bought down by 3. In year two, it's bought down by 2, so your interest rate would creep up to 2. In year 3, it would go to 3%, and then in year 4, it would reset to the normal 4%. Usually, builders offer these as a way to market new construction homes because it makes the payments very affordable, particularly in that first year. But in the first few years, it makes the payments very affordable. And so the lender would pay for that fee. The builder would pay for that fee with the lender in most cases. Anybody can do them, but usually builders do. Growing equity mortgage, the principal payments are increased over time, which pays the loan off more quickly, basically. It's just paying the principal down faster. Any questions about those different types of loans? Good? Okay. All right, so let's talk about the different documents involved here. The note. We mentioned that the promissory note or mortgage note is the IOU document. That's the contract between the borrower and the lender. It says, I borrowed this money and I promise to repay it, and here are the terms under which I'll repay it. The note, to be valid, has to explain the loan in detail. It's got to identify the lender and the borrower, and it's got to show that the property is intended to be used as security or collateral for the debt. It's got to have a legal description of the property that they're lending on. It's got to be in writing, and it must be recorded in order to be enforceable. So, if you want to enforce that mortgage, or what do we call that in North Carolina? Deed of trust, then it needs to be recorded. Okay? So, the borrower, what are their rights? Well, and their duties. Pay the debt, number one. That's the big thing. Make the payment. Pay the taxes, maintain insurance. If you do not maintain insurance, your bank will do it for you, and it will be obscenely expensive. So make sure you maintain insurance on the property, maintain the property itself. And actually, we're supposed to talk to the lender before we make major alterations to the property, but very few people actually do that. Okay? And then they have the right to enjoy the property. Use it and enjoy it. What rights do the lenders have? Well, they have the right to sell that mortgage. Remember, we said that notes are negotiable instruments. Negotiable just means they can sell them. So the lender has the right to sell that mortgage to another investor if they want to. And then, of course, they have the right to foreclose if the borrower doesn't pay. We talked a little bit earlier in the chapter about the different methods of foreclosure. North Carolina, which do we use? Do we use judicial or non-judicial foreclosure? In North Carolina, we use non-judicial foreclosure or power of sale foreclosure. And that's for title theory states. Lien theory states use which form of foreclosure? Judicial foreclosure, which means there has to be an actual lawsuit. You have to sue for foreclosure in lien theory states. Very few, if any, states use strict foreclosure, and you don't need to know anything about it other than it's not used. Okay? Distributing the proceeds of a foreclosure. So let's talk about foreclosure and how this is going to work. How do we distribute the money when a property is foreclosed on in North Carolina? This is the one time in your real estate career where you will get paid first. Notice what the first thing on that list is, the highest priority.
Cost of the sale.
Cost of the sale. Guess what the biggest cost of the sale is in most cases?
Commission.
The real estate commissions. We get paid first out of the proceeds of any foreclosure sale that we're involved in. So, pay the commissions, number one. Pay all outstanding taxes. Then the mortgages, in order that they're recorded. Any other liens, like, what other liens might there be? Mechanics liens, that's exactly right. And then I love this last one. Give the surplus back to the borrower. How many of you think there's ever been a surplus at the end of a foreclosure sale? probably never happened, ever. Because you have to stop and think, ask yourself, why? Why would that happen? How would that happen, right? Like, if there's a surplus, that must mean they could have just sold the property without going through foreclosure, right? If there was enough money after the foreclosure to pay off all these debts and pay off the cost of the foreclosure and there still be money left over, why didn't these people just sell it rather than be foreclosed on? That'd be my first question. My second question would be, do you really think whomever processed the foreclosure is going to care about driving the price up to a point where there is a surplus that they have to give back to the borrower? No. Whoever processed this foreclosure, as soon as there's enough money there to pay themselves, they're letting it go. There's not going to be any bidding wars driving up the number. In fact, I have known Bank of America to refuse offers for courthouse sale foreclosures because the number was too high. Because they did not want to have to track down the borrower to give them the difference. Think about that for a second. They have no incentive to do that. None whatsoever. So there's never going to be any excess. If there was, in theory, it would go back to the borrower. Okay? North Carolina, like...
Go back to that one.
Yeah.
The second thing is pay out outstanding real and personal property taxes.
Mm-hmm.
Real estate taxes come before, like federal, IRS, everything.
Exactly.
Okay.
So it would be real estate taxes, then special assessments, and then any other outstanding tax liens. Okay? The right of redemption. North Carolina uses a right of redemption, like most states do. And so let's talk about what that is and how it works. The right of redemption basically means that the borrower has the right to come in and pay what they owe and stop the foreclosure process. That there's no point in the foreclosure process where the lender can say to the borrower, it's too late, you can't pay us our money. Because the only point in time when it's too late is after the property's already been what? Sold. Exactly. As long as the lender still has that property and has not completed the sale of that property, the borrower can always show up with the amount of money that they owe and redeem the property. Now keep in mind, if they started out owing $100,000, the redemption amount is not going to be $100,000 because all of the attorney's fees, the cost of processing the foreclosure action, all of that will be tacked on. But presumably if they hit the lotto tonight, they could come in and redeem the property. And not only that, when we talk about the foreclosure action, remember I said with those courthouse auctions, there's an upset period. Y'all remember we talked about that early in the class? There's a bid upset period. Does anybody remember how long that bid upset period is?
10 days.
10 days, that's exactly right. So when the bank, in most cases it's the bank, forecloses on a property and they place it for sale at the courthouse, any bid that becomes the high bid has to stay in place for 10 days without a higher bid being put in its place. If a higher bid comes in, that 10-day period is reset and restarted. So basically a bid has to sit for 10 days before it becomes the auction price of the property. And that right of redemption is still going on during the bid period. So if the bid is upset and the 10 days resets, then the time that the borrower has to come in and redeem the property is reset as well.
How would that, how would another bid come in after the auction?
So the auction is basically not really an auction. It's, you go in there and they'll have a binder of properties that are currently for auction, and you place your bid with the clerk of court. Whatever your bid is, you hand them, depending on the count, different counties have different rules. Like for example, in Wake County, it's 20% of your bid amount. Whatever your bid is, you hand them a certified check for 20% of that amount. And then if you win the auction, you have, I think it's 10 days to have certified funds for the difference in the amount. So you go in with a certified check for the 20% of whatever you plan to bid, and you hand it to the clerk of court and tell them the property you're bidding on. That's the auction. And Anybody else can come in during the next 10 days and place another higher bid. And each county has like how much you have to beat that other bid by. You can't just beat it by $1. It's not The Price is Right. You know, you have to, there's a certain minimum amount, and in Wake County that amount is 5%. So it's a pretty big jump. You know, you have to bid at least 5% greater than the highest bid in order to have a new bid put in place. You know, and if you bid one time and put the 20% down and somebody comes and outbids you, you can either come pick up your check and they'll refund it, or if you want to place a higher bid, you just bring another check for the additional 20% of your high, you know, your higher amount. Okay. Deficiency judgments. Deficiency judgments come into play a lot in the foreclosure process because it's very likely that there's not going to be enough money to satisfy all the liens on these properties. That's one of the reasons they made it to foreclosure in the first place, is that there was not enough money to go around. If they sold the property, there wouldn't be enough to cover the debts, and so we get a deficiency judgment. A deficiency judgment is a personal lien, not a general lien. Well, the general lien attaches to what? General lien attaches to what? Yes, person. Sorry, I get two different answers. So, person. What about a specific lien? To a property. So, a deficiency judgment is an example of a general lien. It's going to attach to the person. Now, remember, the mortgage lien was a specific lien. But a deficiency judgment, where there's not enough money to cover the debts on the property, could be issued, and it would attach to that borrower personally. So just because you're foreclosed on doesn't mean you're done with the process. Doesn't mean you don't owe the bank money anymore. The only thing they can take from you is the property, but they can still attach a personal lien to you that'll follow you around. And that lien is called a deficiency judgment. What it really means is that your credit's not going to be very good. And if you ever want to borrow money for anything else again, like buying a house down the road, you're probably going to have to pay off that deficiency judgment. And we do not allow deficiency judgments in North Carolina where seller financing is involved. How many of you ever heard of seller financing? Seller financing is when the seller is the lender. You're making payments to the seller. Now, how is that different than an installment land contract? We talked about installment land contracts. What's the difference between seller financing and an installment land contract?
Because partial of that installment payment goes towards your down payment thing, and the other one, the seller is just kind of lending you the money and you're paying back, right?
So I like the description of seller financing. The seller's lending you the money and they're paying back.
It's when you get the deed.
It's when you get the deed. It's when title is transferred. So what's different about the two of them?
You don't get the deed in a land contract until you've made your last payment.
In an installment contract, I don't get the deed until I've made all the payments. When do I get the deed? When in a seller financing deal?
When you close on the property.
At the very beginning. At the very beginning. As soon as I take ownership of the property, as soon as I take over the property, I take over ownership of the property. Whereas with an installment land contract, I do not. I do not. So in an installment land contract, if I miss a payment, what happens? They kick me out and take it back because I am essentially a tenant, right? In a seller financing deal, I miss a payment, what happens? They have to foreclose. They have to go through the foreclosure process just like a bank would. But they are not entitled to a deficiency judgment like a bank is.
Is there a reason for that?
It's just there's a legal theory behind it. The legal theory is that the whole purpose of the law, when it comes to disputes like these, is to make the parties whole, to put them back in the position they were in before the whole thing started. And when you look at a seller financing deal, what did the seller start with? The property. And if they foreclose, what do they end up with? The property. And so the law sees that as you're back where you started. Whereas with the bank, they started with a certain amount of money. They didn't get that amount of money back, so they're owed the difference in a deficiency judgment. That's the legal idea behind it. Okay? A deed in lieu of foreclosure. This could happen where the borrower simply says to the lender, listen, I'm not going to be able to pay. I'll sign the property over to you. You don't have to go through the foreclosure process. You don't have to take me to court. You don't have to file a foreclosure. I'll sign the property over to you tomorrow. That sounds great. And it does work great when the property's not underwater or upside down, meaning that the borrower owes more than it's worth. Here's the reason you don't see many of these. Most people don't get foreclosed on unless they are upside down. And the banks are very reluctant to take a deed in lieu of foreclosure because they can't get a deficiency judgment. And they don't want to let the borrower off the hook without that deficiency judgment. How many of you ever heard of a short sale? You know what one is? Somebody give me your definition of a short sale.
So the bank, okay, so the bank decides, agrees to let the borrower or to give the house back at the market rate instead of what is actually owed on it. So if the house has depreciated or the borrower owes more than what the house is worth, the bank is saying we agree to take the house for that amount.
Close.
Okay.
Close.
They sell it because they're in a pinch for cash,
Okay.
and they're going to sell it for less than what they owe.
Yes. And so now tie that together with what?
And the bank agrees to let you do it.
Yes. There we go. See how we got the two definitions combined there. So the important things are going on. Number one, we are selling the property, right? And and it's not the bank selling the property. It's the borrower who's selling the property. The catch is they're selling it for less than what they owe on it. Well, normally that's not a catch. The bank just simply says, that's fine, you just cut us a check for the difference, right? I've had sellers bring cash to closing. It's not comfortable. They don't like it. But over the years, I've had a couple times where a seller had to bring a check to closing, where they were upside down on a property. But on a short sale, the seller doesn't have the money to bring to closing. And so the bank is in a tough position. The bank knows that this person, this borrower that they're dealing with, wants out. And they also know that the property is not worth what they've loaned on it. So, is that a dangerous position for the bank to be in? Yeah, because what could happen? What could go really badly for the bank from that point forward?
It could go into foreclosure and then them not get even what they
It could go into foreclosure, and if it does, the bank's going to take the property back and sell it, but they're going to sell it at that lower amount, right? And maybe even lower still, because now you've put that label of it being a foreclosure on it. And it's months down the road from now. Maybe they haven't made any house payments in that meantime. So it only gets worse for the bank. So for a short sale to work, everybody has to be in agreement that we're in a crappy position that's only going to be made worse if we wait. Does that make sense for you? The seller needs to feel that way, and the bank needs to feel that way. The only way the bank is going to agree to a short sale is if they feel it saves them money. If they feel like foreclosure is worse than letting it go right now. Because essentially what the bank is doing is agreeing to remove their lien from the property without that lien being totally satisfied. Does everybody follow that? Now, that doesn't mean they might not get a deficiency judgment. As a matter of fact, a lot of times part of a short sale is a deficiency judgment. Now, they may negotiate a certain amount of that with the seller. Maybe say the property is $50,000 upside down. And the seller wants to do a short sale. The bank says, yeah, we can do one. We'll do that, but you're going to have a $50,000 deficiency judgment. The borrower may say, so I could let it be foreclosed and I can end up with a $50,000 deficiency judgment. Or I can do all this work to get it sold and get you your money right now, and I'm still going to get a $50,000 deficiency judgment? No, probably not. and they'll negotiate with the lender and maybe get a less of a deficiency judgment. Maybe not get a deficiency judgment at all, maybe have it be forgiven. That's happened too. So it becomes a financial negotiation between borrower and bank. The key to the real estate part of it, though, is that the bank is removing their lien on the property for less than what's owed. So it becomes a very complex offer process because the buyer is making the offer to the seller, which is the borrower, owner of the property, but then the seller has to immediately turn around and take that offer where?
To the bank.
To the bank, and the bank's got to sign off on that offer. That can take months. Trust me, the name short sale has nothing to do with the amount of time it takes to process. They are very long, drawn-out processes. Okay? Assumption. Assumption is on page 296, I believe. Yeah, no, I'm sorry, 297. Okay. The assumption of a loan is basically taking over somebody else's loan. And at various points in the last 50 years, assumption's been either really popular or really not popular. We're in a time right now when assumption is really not popular. So let's talk about what assumption is, and then you can tell me why it's not popular right now. Assumption means I'm taking over somebody else's loan. Not because I can't get a loan, because I still have to qualify. If I'm assuming someone's loan, I have to qualify for that loan. Why would I want to take over somebody else's loan as opposed to getting a new loan of my very own? Maybe the fees are lower.
The interest rate.
The interest rate. What if they have a lower interest rate on their loan than I could get if I were to go out and take out a new loan today? So why is that not popular right now? Why is assumption not popular right now? Why are people not looking to assume somebody else's loan right now?
Because rates are so low.
Because interest rates right now are the lowest they've ever been. There's no incentive to assume loans. How about if interest rates go up to 5 or 6% in the next 3 years? Will there be some incentive to assume some of these loans that are being written right now?
Yes.
Absolutely. Absolutely. Makes a tremendous difference in affordability. Having an assumable loan can be a big marketing plus down the road. If you think about it, 2 houses side by side, borrowers looking at both, price point is the same, but I can buy this one and assume the mortgage at 3.5% and my payment's $1,400. Or I can buy this one and take out a new mortgage where my payment is $2,000. Which property am I going to offer on more quickly?
The assumption.
The one where I can assume the loan. Absolutely. So assumption is very popular when interest rates are going up because it's a way for borrowers to help, avoid some of the higher interest rates. Yes, ma'am.
Might be off.
Sorry.
Just real quick.
Yeah.
Here in Wake County, because the interest rates are, I guess, this is what I'm assuming, the interest rates are very low right now. So, I've noticed that, just in 2 years, the asking price for some of the new construction homes, have gone way up. Like even out, like if you go to the Garner, Clayton, Wendell area, where 3 years ago the asking price on some of the new construction was, maybe 250, high threes. They're 400 and up now. And here in the area that I live in, it's 600,000 where it used to be 3 years ago.
Ooh, nice to know you. My goodness.
400,000. So I'm thinking, is it because the interest rate is so low is the reason why?
That's one of the reasons. Absolutely. That's certainly one of the reasons. Competition is another reason. I mean, we have a lot of people moving to the area, and so we have a shortage of housing. That's a reason. But even with a shortage of housing, the rate at which we're seeing price increases is largely due to interest rates being where they are because buyers could not afford these kinds of numbers if interest rates were higher. It's not like these people are paying cash for these houses. They're coming in and they're financing. Well, obviously my affordability for financing is much higher at 3.5% than it is at 5.5%. And so, yes, a large part of what you're seeing with price increases happening so rapidly is due to the extremely low interest rates. As interest rates go up over time, you won't see those kinds of rapid price increases, because buyers won't have the flexibility, they won't have the ability to continually afford more and more and more,
Right.
because more of their payment's gonna go toward interest.
Right. That's what I figured.
Yep.
Okay.
Yep, that's a lot of it, absolutely. Good. Sorry. There's also on page 297 in your book, it points out the difference between assumption and buying subject to. I don't want to spend long at all on buying subject to somebody's mortgage. Remember in landlord and tenant we talked about the difference between subleasing and basically a new lease, a novation, a new lease. We talked about the difference between those two, assignment of a lease or subleasing. And we said that in one, the original tenant remains responsible, and the other, the tenant does not. So in a sublease, the original tenant remains responsible. In an assignment, they don't, right?
Correct.
Well, the same thing is sort of true here when you are talking about an assumption versus taking ownership subject to someone's mortgage. In an assumption, you truly are taking over their mortgage. The new borrower becomes the new borrower. They become completely responsible for the repayment of that loan, and nobody else is responsible for the repayment of that loan. Whereas with the taking ownership subject to somebody's lease, the old borrower remains responsible for the loan. So basically, you're really trusting somebody to make the mortgage payments for you, and most lenders will not allow that.
So basically, it's like signing for somebody's car?
Yeah, but yes, sort of, but you're not signing for them because you already had the loan in place. You're just basically letting them pay, but the loan's still in your name.
Okay, so it's like this. So my first apartment, it was my mom's boyfriend's apartment. He wanted to move into our house, and I wanted to move out the house. So we just basically switched, and I thought that I was getting put onto the lease as like the main person, but actually I was just like a tenant or something. So kind of like that.
Yes.
Okay.
Yep. Yep, that's exactly right. Okay. And that's it for chapter 13. Okay. All right. So let's kind of roll right into 14, and then we'll take a break sort of midway through here. Chapter 14 is still finance, of course, but finance on a bigger scale. Finance, instead of talking about one loan at a time, now we're talking about the big secondary mortgage market, where loans are sold, okay? Where loans are sold. In chapter 13, we're talking about the origination side of things, where loans are made. So, where the borrower meets the lender, and a loan gets made. That's the primary mortgage market. The secondary mortgage market is where loans are sold. So, they're packaged up together and they're sold in big blocks or chunks to investors. Okay? That's the secondary mortgage market. And we're going to talk about how that works, what some of the major factors are in the secondary mortgage market, and all that good stuff. The Federal Reserve System is a huge player in anything that has to deal with finance and lending. And that is very much true of the mortgage industry. The Federal Reserve does not control mortgage rates, but they control interest rates, or the federal discount rate, and that has a direct impact on the interest rates on every loan, on every type of loan, including mortgage loans. So while the Federal Reserve doesn't set mortgage rates, they do have some influence over mortgage rates. If the Fed raises rates at the discount window, then interest rates on mortgages are certainly going to go up as well. All right? The purpose of the Federal Reserve is to maintain sound credit conditions. In other words, to keep the money moving. They are there to control both inflation and deflation. Both inflation and deflation can be bad. Usually, though, we prefer inflation to deflation. Deflation is actually worse for the economy than inflation is. Give me a definition of inflation.
When I was a youngster, gas was like 99 cents a gallon,
Yeah?
and now gas, which is not a horrible amount of money,
Right.
it's like $1.99 a gallon.
Yeah. So inflation means a dollar goes less distance, right? literally in the case of gas. There's less purchasing power for the same amount of money. Prices go up for the same goods and services. That's inflation. Deflation is the opposite, when prices are falling for goods and services. It sounds like a great thing, deflation. It's terrible for an economy because it creates this sense of waiting. When you have deflation in place, think about yourself shopping. Why does everybody go shop on Black Friday? Because things are cheaper. What if you thought, oh God, that price is great, but next week it'll be cheaper? What would you do? You wait till next week, and then when next week rolls around, you thought, God, man, that is a good price, but God, that stuff's still getting cheaper. I better do what? Wait. And that continued waiting, what does it do to the economy? Stagnates it, right? Wait. All the money sits on the sideline, nothing ever happens. Deflation's terrible. So the Federal Reserve does everything they can to prevent deflation. Now they want to prevent runaway inflation, but some level of inflation is okay and is even actually desired. So they do that by controlling the flow of money, and you control the flow of money by controlling interest rates. So the Federal Reserve's purpose is to control the flow of money through our economy by having a handle on the interest rates that banks pay to each other. That's what that discount rate is. Okay? The rate that banks pay to each other. All right? You don't need to know that map, but it gives you an idea of the different areas of the Federal Reserve. We are in Section 5. Okay. They also supervise the Truth in Lending Act, which we're going to talk about much later in this chapter. And also a big part of the Federal Reserve now is the Consumer Finance Protection Bureau, which we talked about a little bit earlier, who helps maintain the rules for what lenders need to do as far as disclosure about loans. I'm not going to spend any time on this slide here, but it gives you some definitions of some of the things associated with the Federal Reserve. The discount rate is the amount of interest the Fed charges banks to borrow money, and the federal funds rate is money that is lent to member banks without collateral, so they don't have to post any collateral for that. All right? What's the purpose of the Treasury? Well, first of all, to maintain our currency, which is kind of an important function. They maintain our currency, but they also provide insurance for the banking industry through the Federal Deposit Insurance Corporation. And that is an extremely important function because it creates a sense of security with banks. One of the major contributing factors to the Great Depression was a run on the banks, because people were afraid that the banks would run out of money, that they would not be able to get their money out of banks. And they ended up being right, because when they all tried to withdraw the money at the same time, the banks did not have enough cash on hand to cover all of those deposits, because a lot of it had been what? Where did it go?
It was lent out.
It was lent out, absolutely. Think about what banks do. They take your deposits and they loan that money out, and they charge interest on that money, right? Well, if everybody goes to the bank all at the same time tomorrow and tries to withdraw their funds, is the bank going to have enough cash on hand to do that? No. No bank does. No bank did then, and no bank does now. The difference now is that depositors are insured by the federal government through the FDIC insurance program, such that if the bank runs out of money, your funds are guaranteed by the United States of America. Up to, does anybody know the limit? $250,000. Up to $250,000 per depositor, and that's per account. So if you have accounts at multiple banks, then you have coverage for $250,000 in each bank that you bank with. Okay? That is, unless you bank with credit unions. If you bank with a credit union, they have their own insurance program, but they are not FDIC insured. Don't ask me why, I have no idea. I just know they're not allowed to be FDIC insured. So we talked about the primary mortgage market. It's where the loans are made. The money is made here through collection of payments and interest, and through the charges that are charged at the time of origination. So Origination fees, for example, would be a source of income in the primary mortgage market. Interest is a source of income in the primary mortgage market. And also servicing the loan, because a lot of times when the banks sell these loans, they still service them. So if Bank of America loans me $200,000 and they don't hold my note, they sell my mortgage to somebody, they may still maintain the servicing rights to that note. Think of it this way, the investor that they're selling to probably doesn't have a system built in to collect payments every month. So let's say I'm the bank and I have found the borrower, underwritten the loan, loaned them my money. Now I'm looking to sell this loan. Karen has some money she wants to invest, but she has no idea how to deal with borrowers. She hates dealing with people. She doesn't want to deal with the borrower. She doesn't want to collect that monthly payment. She just wants to make a safe investment and be able to collect the earnings from that loan over the next 30 years. And the earnings are going to be the what? The interest. That's all she wants. So she negotiates with me to buy that note from me. See, why do I want to sell it?
Because I've already made the bulk of what I want.
Because I've made money already on issuing the loan and I want my money back. Because I can do what with it? Loan it out again and make more fees off of it and then come back to Karen and say, hey, you want to buy another? Does that make sense for everybody? Now, Karen doesn't like dealing with people. I'm already set up to deal with people. I made the loan. Do I already have this person's billing information to collect their monthly payment? Do I already have the systems in place to collect their monthly payment? Do I probably already have them on an automatic draft collecting that monthly payment? Yes. So Karen says to me, I'll buy the note and I'll pay you to service the loan. What do you think it means when I say service the loan?
To maintain it.
To maintain the payments. So now, instead of me having loaned out my money and collecting principal and interest on my money, I made money in origination fees when I wrote the loan. I made money when I sold the loan. And I'm making money on a monthly basis by doing what?
Maintaining.
Maintaining or servicing the loan, which consists of collecting the monthly payments and sending the majority of that payment back to Karen, but keeping just a little bit for myself, for my trouble, for collecting that payment every month. Does that make sense what a servicing fee is for a lender? And that's very common for banks to maintain the servicing of their loans, even if they don't own the loan anymore. So that payment may still be going to Bank of America, even though they don't own the loan anymore. Okay? Where does the money come from in the primary mortgage market? All kinds of places. Banks, savings and loans, thrifts. These are all known as primary or fiduciary lenders. Okay? Also, insurance companies. Insurance companies have a ton of cash, folks. Insurance premiums just pile up in buckets of cash. And the insurance companies make money by loaning out those premiums. And that's how they make their money. They don't make their money on the insurance products themselves. They make their money by collecting your money for a long period of time, using your money to make money until they have to do what with the claim? Pay it out. Particularly in the case of life insurance. So life insurance companies have gobs of cash to invest, and traditionally, where was a lot of that cash invested? In the mortgage market. How many of you have ever heard of AIG? AIG is the largest insurer in the world. It almost failed during the mortgage meltdown. And people said, how the hell did this get to the insurance industry? Because where was AIG dumping all of their premiums?
Mortgage market.
In mortgage market. They were buying mortgage-backed securities with all of their premium revenue.
Well, they would almost have to, because you don't pay as much in premium as you
get paid out on your claim. They have to invest it somewhere. So one of the traditional choices has been in mortgage-backed securities for the insurance industry. So it's a major source of funding in the primary mortgage market. Credit unions are a large source of funding. Retirement plans. Retirement plans for major corporations are big sources of money in the primary mortgage market. Okay? Pension funds. Endowments, so like universities have large endowments of money, they'll buy mortgage-backed securities to create returns on that money. All those are sources of money in the primary market. Banks originate loans with the intention of selling them to investors and receiving a fee for servicing the loans. Okay? These are not mortgage brokers. Mortgage bankers and mortgage brokers are two different groups of people. Mortgage bankers are lending their own money. If I go in the door of State Employees Credit Union, I am dealing with a mortgage banker. Because the money they're lending belongs to who? Them, State Employees Credit Union. If I go in the door of Corporate Investors Mortgage Group, I am dealing with a mortgage broker. Whose money are they lending?
Others.
Somebody else's. And it could be anybody's money. And one of the weird things you'll learn about the mortgage market is you never know if somebody's going to get a better rate from a mortgage banker or a mortgage broker. I have had cases where people had banking relationships with Bank of America, for example. And they went to a Bank of America branch and they got quoted a rate on a loan. And I encouraged them to contact a mortgage broker and shop it around and compare. And they ended up getting a better rate from the mortgage broker.
I believe it.
And then so then we asked the mortgage broker, well, whose money is it? Where's the money coming from? And what do you think they say?
From the bank.
Bank of America. And the client will look at them and go, well, I bank with Bank of America, and they gave me blah, blah, blah rate. How are you able to give me Bank of America money at this rate? Well, the difference is the banks give discounts to the mortgage brokers because the mortgage brokers sell loans in bulk. They sell a lot of them. And it's just like selling toothpaste. The more of it you sell, do you think that the mom and pop pharmacy on the corner pays the same for a tube of Crest that Walmart pays for a tube of Crest?
No.
They don't, because they buy it in bulk, right? And the same thing is true of the mortgage market. If you sell a lot of loans, you get better rates from the lenders. So it's very common to get better rates from brokers than directly from the banks themselves. And there's a lot of reasons for that. If you're getting it directly from the bank, from a mortgage banker, they've got to pay the salary of that person who's sitting there working on that loan. Whereas if they sell it through a mortgage broker, that broker's being paid a commission. They're being paid the fees and stuff. And so the bank can lend out that money at a lower interest rate because they're not having to pay the salary of whoever's doing the underwriting on the loan. So it saves them some costs sometimes. Okay? Brokers are not lenders. They're simply bringing the borrowers and the lenders together. And they definitely do not service the loan. Now, the secondary mortgage market is where all this stuff is being packaged up and sold. The whole purpose is to get the money back to the primary mortgage market. That's why we have a secondary mortgage market. Let's talk about problems if we didn't have a secondary mortgage market. And we learned most of these lessons from the Great Depression. When the Great Depression started, nobody thought of it as, first of all, the Great Depression for many years after the fact. But when the collapse started that led to the Great Depression, it had nothing to do with real estate. It had to do with the stock market. The stock market crash led to a lot of people having to pull cash out of their cash reserves. And where do most people keep their cash reserves? In the bank. Well, because the stock market crash was so severe, lots of people needed to pull their money out of banks to cover their losses in the stock market. And quickly the banks reached a point where they didn't have any more what? More cash to give out. They could not cover the withdrawal demands on the banks. Well, when word gets around that this bank over here ran out of money, what happens to the other bank down the street? Everybody goes crazy and runs to the bank to get their money because nobody wants to be the last guy standing there with a deposit book that says I have this much money, but the bank doesn't have the money to give to me. Remember, there was no such thing as FDIC insurance then. If the bank was out of money, they were just out of money. Because the banks ran out of cash, and because literally people were rioting outside of the banks and setting them on fire and threatening and killing bankers, the banks said the only way we can get this money back in-house is to call our loans due. they had loaned money out to do things like purchase homes, to purchase farms, to purchase real estate, and they instantly called their loans due, even though people were in good standing. They simply said, we have to have this cash right now because we've got people trying to withdraw this cash. So they foreclosed on properties across the country to get the cash back in hand. Well, what happens to property values when you start just foreclosing on properties? They all drop. Meanwhile, nobody had the cash to pay for them anyway because they couldn't get to the cash. And so what started as a stock market collapse quickly became a real estate collapse through the banking system. Does that sort of make sense for everybody? So part of getting it going again was to get real estate going again. Well, to get real estate going again, you needed to have the banks lending money again. Except the banks didn't have what? Money. And the banks weren't interested in making loans where it took them 30 years to get their money back because they didn't have cash on hand at that point in time. So the part of the recovery from the Great Depression was the federal government stepping in and essentially setting up what we know as now as the secondary mortgage market. The federal government came in and through various reform programs said, we need a way to have there always be a source of money so that the banks don't run out of access to money to lend. I used to teach it this way, and you younger people won't have any idea what I mean. Old-fashioned motels on the side of the road used to always have the same neon sign. And it was the word vacancy. And it was always lit, but then there was the word no in front of it. And they would just flip a switch and the no would come on. It meant they were full. And when they had rooms, they would turn the switch off and it would say vacancy, right? Well, if we didn't have the secondary mortgage market, your bank would have a sign out front that would say money, no money. You know, and one day when they had money to loan, you could go get it. And the next day when you went, they didn't have any money, you couldn't get a loan. That kind of thing is terrible for sustained value in property. So a lot of what we know as the secondary mortgage market now came out of the Great Depression, and it came out of reform measures that were designed to prevent that sort of thing again. So the first, and still the greatest, whether you like it or not, it's the big 800-pound gorilla on the corner, reform that was created to replenish the money in the mortgage market was the Federal National Mortgage Association, affectionately known by its acronym FNMA, or Fannie Mae. Fannie Mae has been around since the Great Depression, or recovery from the Great Depression. And Fannie Mae was created by the federal government, even though it was a private entity. And the federal government basically said, we're going to create this private company and we're going to sell stock in it. Just like any other corporation, we're going to sell stock in this company. Except this company's not going to build cars and they're not going to build typewriters. In fact, they're not going to build anything. The only thing this company's going to have as an asset is going to be mortgages. And they're going to buy lots of mortgages. Why are mortgages good to have in bulk? What do you get out of owning a bunch of mortgages?
Security.
Security, and what else? If you're an investor, income, right? Mortgages generate income from interest. So the idea of buying stock in Fannie Mae was that you had some share of that flow of income. Does that make sense for everybody? Now, why is it a governmental agency? Why is it a quasi-governmental agency? It sounds private to me. I buy stock in it. They buy mortgages. They pay me earnings on my stock based on the mortgages doing well. Doesn't sound like the government should be involved in that. Here was why the government involved themselves, or how the government involved themselves, and the way that they got Fannie Mae off its feet. It was fine to create it, but they knew nobody would buy stock in it until it was shown to be successful. The only way you can make something be successful whose only purpose is to buy mortgages is to have it start buying mortgages. And they needed to get the ball rolling. So they designed Fannie Mae with one very notable difference from every other private company. Fannie Mae has the ability to borrow money directly from the United States Treasury. No other corporation in the history of the United States has the ability to at all times directly tap the United States Treasury and borrow money. And what do they do with that money that they borrow from the United States Treasury? They buy mortgages. And if the banks can find somebody to buy their mortgages, what do they do in regards to mortgages? They write more mortgages. Because remember, how do the banks make money now? If they're not keeping the loans and keeping the earnings from the loans, how do they make their money?
Servicing.
The fees for making the loans and the servicing for collecting the payments. So how do I make more money if I'm a bank? Make more loans. And do I care that I'm making more loans? Because can I run out of money anymore? No, I cannot run out of money because somebody's going to buy the mortgage. Does that make sense for everybody? You understand the thought process behind Fannie Mae, why it was created, and the purpose it served. It was to keep a continuous flow of money in the mortgage system. Everybody okay so far?
Yeah.
Have I lost you, confused you? Because I want you to understand what the purpose of Fannie Mae was. Now, Fannie Mae is a private company. Private companies are created to make money, not to help people out. Fannie Mae doesn't buy junk mortgages. They never have. Particularly in the beginning, Fannie Mae was very particular about the kind of mortgages they would buy. You had to be a very good borrower for Fannie Mae to buy your mortgages. Here's what changed in the mortgage industry. Prior to the Great Depression, the mortgage lending process was very much about how much your individual bank trusted you to repay the loan. Because it was the bank's money you were borrowing, and it was the bank that you were paying the money back to. Fast forward to Fannie Mae coming on the scene. Who am I paying the money back to long term? Fannie Mae. Does Fannie Mae know the borrower?
No.
No. Does Fannie Mae have any ability to trust borrowers they don't know? No. So does Fannie Mae make individual decisions and go, oh, you know, he's a nice guy and I really trust him and he'll pay me back? No. Fannie Mae says, you meet this criteria and we'll buy your loan. Well, if the banks change their dynamic from I make money from collecting interest over 30 years to I make money by writing this loan now and getting the damn thing sold as quickly as possible, what loans do they start to make, and only those loans? The loans that they can do what with? Sell. So when you walk into a bank and the bank says, well, the Fannie Mae lending guidelines are this, that's really a lie. Fannie Mae doesn't have lending guidelines because they don't make loans. You're not borrowing money from Fannie. You're borrowing it from Bank of America. You're borrowing it from SunTrust. You're borrowing it from BB&T. You're borrowing it from State Employees Credit Union. You're borrowing it from any one of those sources. They have the ability to make any loan they want to. But the reality is Fannie Mae does have guidelines for what kind of loans they will what? Purchase. And the bank is only interested in making loans that they can sell. So therefore, the banks will use the Fannie Mae guidelines as their own guidelines because they know they can do what with that loan once they make it? Sell it. Now you're starting to see the big picture of how that whole process works?
Yeah.
So ultimately, it is Fannie Mae who sets the guidelines for most loans in this country because the banks are only interested in making the loan and getting it sold as quickly as they possibly can. Follow me so far?
Yes.
Good. Now, it became apparent after a while that there was a flaw in this Fannie Mae system. The flaw in the system was that the government, in addition to creating Fannie Mae, also created some government-backed loans. They created these government-backed loans, and we're going to talk more about those in a second, called the FHA loan and the VA loan. The VA loan in particular was seen as very important because it was designed to help veterans who were coming back from World War II be able to purchase homes. And the thought process was, you know, it's not fair to expect these guys to be able to put 20% down on a house because where have they been for the last 4 years? Been off fighting a war. They didn't have the ability to save up 20%. So we need to have a way for them to be able to purchase homes without putting any money down. And so the VA loan program was created. The problem was Congress doesn't have the ability to loan out money in housing. Congress doesn't have the ability to force banks to make loans. So they could create the loan program, but nobody was willing to issue the loans because nobody was willing to do what in the secondary mortgage market?
Take the risk.
To buy the loans, take the risk, which is exactly right.
Okay.
If I'm the investor and I'm buying that loan, I'm taking on that risk, right? And it was seen as very risky to take on the risk of somebody who didn't make a down payment. With me so far?
Yeah.
Enter Ginnie Mae. And this is where people start to get confused because of the names. The Government National Mortgage Association was created to address this problem. Fannie Mae wouldn't buy these VA loans. Fannie Mae wouldn't buy FHA loans because Fannie Mae's board of directors said that is risky. And we ain't in business to take risks. We're in business to make money. We have stockholders to answer to. We have shareholders who want their earnings and want their dividends. And we're not buying that mess because it's risky. So Congress went back to work and they said, okay, how do you convince somebody to buy something they see as risky? In property management chapter, we talked about the idea of transferring risk. How do we say you transfer risk?
You said, well, we said in property management it was insurance.
Yes, you transfer risk with insurance. So Congress said, well, what if we find a way to make these risky loans not risky? How do you transfer risk? Insurance. How do you transfer risk away from risky mortgages? You insure the risk. So Congress came up with an idea that said, and they went to Ginnie Mae, or they went to Fannie Mae, and they said, what if we created a system where we would insure you against the loss on these VA loans? We would insure you against the loss on these FHA loans. Would you be willing to buy those loans then if the risk of loss was insured by us, the United States federal government? What do you think Fannie Mae's answer to that question was?
Absolutely.
Well, hell yeah! Who wouldn't buy something that the risk is being assumed or insured by the federal government of the United States, right? That's where Ginnie Mae comes into the picture. Ginnie Mae's only purpose, and Ginnie Mae's not a private company. Ginnie Mae is a wholly owned subsidiary of the United States federal government. Ginnie Mae's only purpose is to buy the risky loans that Fannie Mae will not buy. With money that comes from where? Federal government. And then they sell them. They do sell them. They immediately sell them, as a matter of fact. Who do they sell them to? Fannie Mae. But in the process of buying them and selling them to Fannie, what have they done to them?
Insured.
They've insured them. They've insured them. They've said that, Fannie, you buy this loan from me, and if it fails, you come back to me and I'll do what? I'll make it good. I'll pay you. How much risk is there now for those FHA and VA loans that Fannie Mae buys? Very little. Does Fannie Mae like buying FHA loans and VA loans now? Yes. Because the risk has been passed off to the federal government through the insurance program. So if I ask you what is an FHA loan, an FHA loan, folks, is nothing in the world but a loan where the federal government has insured the risk. A VA loan is nothing in the world but a loan where the federal government has insured the risk, and they do that through Ginnie Mae. Now did I lose you? Is everybody okay with that? Understand the basics of it. So Fannie Mae, when I ask you, does Fannie Mae buy risky loans, your answer should always be what?
No.
No. They don't buy risky loans
Because they're not risky.
because they're not taking the risk. They buy very solid loans, and they buy risky loans that have been insured by somebody else. Following that so far? That's the idea behind Fannie Mae. And that's why Fannie Mae was seen as such a safe haven for people's money during the mortgage meltdown. Because Fannie Mae had never taken big risks. Fannie Mae had always bought the safest of the safe. And so when you bought stock in Fannie Mae, it was a you can't lose prospect, which became kind of dangerous because it did lose. That one time, it did lose. And it lost because the entire system collapsed around it. They were still the safest, but sometimes when things go really bad, even the safest isn't safe any longer. And that's what happened in the mortgage meltdown. Okay? Let's take a quick break. Okay, so we talked about Ginnie Mae. We're not even going to deal with Freddie Mac because they don't exist any longer. You don't have to worry about them. I have hinted about the recent financial crisis a lot and talked directly about it somewhat. Fannie Mae and Freddie Mac were both placed into government conservation measures. Freddie Mac never came out. Fannie Mae has. The goal was to sort of protect the assets, reduce the portfolios, and in some cases the portfolios were increased in Fannie Mae's case as the market started to recover. Some of the reasons of the meltdown, things called subprime mortgages. Subprime mortgages are mortgages made to increasingly risky lenders. And in a lot of cases, the risk from those mortgages was sort of hidden from the investors who were buying them. I don't want to get too deep into the weeds here because it's not tested, but to give you an idea of what was happening with the subprime mortgage crisis, you know, Fannie Mae has to rely on the rating agencies when they buy mortgages, because they don't buy individual mortgages, they buy mortgages in groups of, you know, tens of thousands of mortgages. And when you're buying mortgages in groups that big, of course, some of them are going to be better than others, and some of them are going to be, you know, not as good as others. And the rating agencies, like Moody's and Standard & Poor's, had a very interesting way of rating packages of mortgages. They basically came up with a formula whereby they said, you know, 10% of any batch of mortgages that comes from a certain source are bad and the other 90% are good. So their method of rating things was to essentially take the 10% worst loans, strip them away, and then rate that other group that was left over as what they called AAA debt, which AAA debt was supposed to be can't miss, can't fail, and that's the kind of debt that Fannie Mae wanted to buy. Makes sense, because they want to buy the stable, sturdy stuff, right? So the rating agencies would say, okay, the top 90% of this is good, the bottom 10% is bad. And that number had been so consistent over time, they really just kind of stopped looking. And so they just assumed that any batch of mortgages, the top 90% was good, the bottom 10% was bad, and Fannie Mae would buy that top 90%. Well, some of the banks figured out that they would just take that bottom 10% that was garbage and put it all into one big package of mortgages and see if the ratings agencies were paying attention. Well, guess what? They weren't. So they took all the stuff, that bottom 10% garbage, and they packaged it together and they sent it to the rating agency. You know what the rating agency said?
10% bad?
10%
bad and 90% good. So guess who bought the 90% good? Fannie Mae. Right? Well, what was the 90% that was good in those batches?
The former 10%.
The former 10% that was garbage. And when the banks figured out that that worked, they took the 10% that got kicked back out of that and cobbled it together with the 10% over and over and made it into even bigger piles of stuff that was then rated as AAA and sold to Fannie Mae. So Fannie Mae thought they had portfolios full of billions of dollars worth of prime loans, when what they really had were a portfolio that was a mixed bag of prime loans and subprime loans. That's how you get a mortgage meltdown, because people who were investing in that thought they were investing in can't lose securities, but they were actually investing in securities that were to some extent destined to fail, because there was a bunch of really bad mortgages in that grouping. That's my 2-minute explanation of the mortgage
Did the
meltdown.
ratings agency ever pay any kind of penalty on that?
They did not.
How's that fair?
It ain't.
You should watch The Big Short, the
I've
film.
seen it.
Yeah.
It ain't, and they didn't. No, it's not right, and it's an but here was the drive for the ratings agencies to do what they did. The banks had a choice of ratings agencies. When the banks would go to Standard & Poor's, and Standard & Poor's would look too hard and say, this is garbage, then Barclays or Bank of America or Deutsche Bank would say, oh, that's fine, we'll take it over to Moody's, they'll rate it for us. Well, how do the ratings agencies make their money? By rating. And if the business got moved from one to the other, they lost money. So the incentive was to look the other way, right? The incentive was to essentially abandon their entire job, which was to rate. And that's what they did. And everybody relied on those ratings. Almost everybody. The few that didn't make a lot of money. But does that kind of make sense? That's how Fannie Mae got stuck with a bunch of losses. That's how Freddie Mac got stuck with a bunch of losses. Because they were buying debt that was rated AAA that ended up being not a long way from AAA. They put a lot of faith in the rating system and it didn't work. So did AIG. AIG put a ton, almost $1 trillion worth. Trillions, 1,000 billion. A lot of money. And so that's how you got a subprime mortgage meltdown, because they were making loans to increasingly risky borrowers to feed the process, and those loans were defaulting at astronomical rates and still being rated at. In fact, at one point it got so bad that one lender on the West Coast had a 35% first payment default rate. You know what a first payment default is?
They don't
They
make
never-
They never made one payment on the loan. And that was at 35% of the loans they were issuing at one point. So in 35% of their mortgage portfolio, people weren't making even one payment.
How does it even get to that point?
It gets to that point when the people who are supposed to be guarding the gates stop doing so. So when the ratings agencies essentially threw all the standards out the window and were willing to rate everything AAA, then the investors at Fannie Mae were willing to go with the assumptions they had always gone. Trust me, they knew. I mean, in the back of their minds, they knew that there's no way we've gone from this number of AAA borrowers to this exponentially high number of AAA borrowers overnight. Somebody, somewhere along the line, but they all had plausible deniability. They all had the ability to say, we've always bought AAA debt, and that's what we're doing right now. So they knew they were insulated from the blowback from it. And the investors who were buying stock in Fannie Mae knew something was going on too. And by the way, that's us. That's people investing their retirement incomes in Fannie Mae stock. That's your money market manager who's investing your 401k. That's all of us investing in Fannie Mae stock, because Fannie Mae stock had traditionally had a very modest return because the only earnings they got were from interest on home loans, which was at modest rates. Well, one of the reasons Fannie Mae stock went through the roof was because Fannie Mae's returns went through the roof. How did their returns go through the roof? Because the interest rates on the loans that they were buying were getting progressively higher. Why were the interest rates getting progressively higher? Because they were progressively riskier loans. But they weren't being sold as risky. They were being presented as not risky, but they just magically had these high interest rates that nobody could figure out. Well, if you had AAA debt at a 10% return, everybody and their brother, literally around the world, invest their money in that. And that's what happened. And Fannie Mae's portfolio got astronomically large to the tune of about $17 trillion. And a lot of it was junk. And when the junk starts to fall, it falls fast and it falls hard. And that's what happened. You know, you had mortgages that were written on a wink and a nod. I mean, I could show you videos from 60 Minutes at the time where they went in and they looked at World Savings in particular. And it wasn't just World Savings, but that's the one they chose to look at. And they had a mortgage processor, a loan processor, auditor, who was basically a whistleblower there. And he said, you know, these loans were garbage. And the more you told somebody that they were garbage, the more they told you to shut up and don't rock the boat. You know, he said that anybody that could fog a mirror, we had financed them 3, 4, 5 times. You know, and they had one lady on there, and she said, you know, they went by my husband's income at the shipyard. And the interviewer said, but he had already been laid off. She said, no, he was passed away. And they actually had the original loan documents. And somebody made a note in the margins. Husband died last year. Annual income, husband's income, shipyard. And they put, to qualify her for this loan, they put her dead husband's income on the loan. The payment was more than her monthly income. She literally could not make the payment even if 100% of her income had gone toward that payment, but they qualified her for that loan. That's a loan that's destined to fail. But that's what happens when all the fees are front-loaded. The bank is selling the risk to somebody else. The bank doesn't care because they're going to sell it Fannie Mae. Fannie Mae should care, but they don't because the ratings agencies are saying it's good. Oh yeah, go buy it. That's a great loan. When it wasn't. Right? That's how you get a meltdown. That's how it happens. And there were plenty of signs. Plenty of signs. I mean, those of us on ground level were going, what is going on? I had clients who made a third what I made. And this was not when I was really established in the business. So it's not like I was lighting the world on fire. But, you know, I had clients who were making $40,000 a year buying $400,000 houses. Mm-hmm. And you're looking at it like, how is that possible?
Yeah, what do you do on the side?
Yeah, you were scared to ask in some cases, and it was just insane. It was insane. And it could not be sustained. And here it was much less insanity than it was in lots of other places like California. But unfortunately, once it ripped loose, it was like a wave washed across the country of foreclosures, defaults, you name it. And once that starts, even the good loans start to default because the property values dropped so much in so many markets that people just walked away from them. They thought, well, I'm $300,000 upside down on this property. My credit's not worth $300,000. And they just walked out the door. And these were people who had done it right, put down 20%, made the payments, and they were just big, and so it was just an avalanche. I mean, once it went, it went. That's the mortgage meltdown. All right? Sounds nice, doesn't it? Types of loans. Private loans are called conventional loans, and then government-sponsored or government-backed loans. Now, the key here is that banks are making both of these loans. There is no difference between a private or conventional loan and a government-backed loan when it comes to where the money comes from. Banks make all the loans. The difference is who is responsible for the risk involved with the loan. In a conventional loan, the bank themselves is responsible for the risk, or they require the borrower to get private mortgage insurance. Okay? So in a conventional loan, the bank themselves is taking on the risk, or they're requiring the borrower to go out and get private mortgage insurance on the risk. In a government-backed loan, who do you think is taking on the risk? The federal government is. That's the only difference. Us, right. That's the difference between the two categories of loans. It's not where the money comes from, because it all comes from banks. It's where the risk is. Okay? Everybody good on that? Okay? Conventional loans. Generally speaking, conventional loans have higher standards than government-backed loans do. Remember, the whole purpose of the government-backed loans was to get loans in the hands of people who otherwise couldn't get them, right? People like veterans, for example. The whole purpose of those loans being created was to get loans into the hands of people who could not get them otherwise. So that should tell you that people who get government-backed loans in general are considered to be riskier borrowers. And that could be a variety of factors. Maybe the credit scores are a little bit lower. Most likely, it's due to the down payment factor. Government-backed loans don't require much or any down payment in some cases, whereas conventional loans require a higher down payment. So, let me ask you this. If a conventional loan, you make a higher down payment and you have to have a higher credit score, is that a higher quality loan with less risk than a government-backed loan is, where you can have a lower credit score and a lower down payment? Is it fair to say that the conventional loan is a higher quality loan?
Yes.
From a risk standpoint? Yes, absolutely. And that is the thing that really signifies the difference between a conventional loan and a government-backed loan. Usually, higher quality borrowers have conventional loans. Now, don't take that as a personal judgment. I don't mean higher quality and they're better people. I just mean from a financial standpoint, they are less risk based on a combination of credit score, income, and down payment. They are less risky. They are higher quality borrowers because they're less risky. And those mostly are your conventional borrowers. Okay? Conventional loans come either insured or not insured. So let's talk about insurance on mortgages. Matter of fact, I can leave my 80% LTV up here because that's the magic number when it comes to insurance on mortgages. Remember, we said LTV is the percentage of the property's value that we borrow, right? Most lenders are very comfortable with this number. 80% loan to value has been long sort of the gold standard of lending. That you were safe as a lender in lending up to 80% loan to value. Why do you think that is? What's the nasty side of lending? If everything goes bad, what happens? Foreclosure. In foreclosure, what is the bank doing? Taking the property and then what?
Selling it.
Selling it to get what?
Money.
Their money back, right? And so banks have always felt that if they didn't extend more than 80% of the value of the property as credit, that they were protected in the event of a foreclosure. That they could foreclose on the property, sell it, and still be able to get all of their money out of it. Does that make sense to you guys? I'm not saying 80% is always the magic number, but that's the traditional one. And so, any loan that's 80% loan to value or lower is going to be not insured. In other words, the bank is going to feel comfortable that the borrower has enough equity in the property that they don't need insurance on that loan. But any loan that goes higher than 80% loan to value, where the borrower is borrowing more than 80% loan to value, 85%, 90%, 95%, most likely the borrower is going to, the bank is going to require some type of insurance on that loan. The question is going to be, is that insurance going to come from a private company or is it going to come from the federal government? In conventional loans, where does it come from? Private companies. We call them private mortgage insurance.
Is it based on your credit score too?
It is based on credit score, absolutely. Absolutely. It's not just a loan to value consideration. It's loan to value, income, credit score, all of those considerations, go into play. But that is, generally speaking, sort of the magic number for where PMI has traditionally been required. Anything above 80% loan to value, once you fall below 80% loan to value, you don't need mortgage insurance any longer in most cases. Now, this is one of the things that I think people get confused about mortgage insurance. Mortgage insurance does not cover the entire loan. Remember, Banks, if you borrow 80% or less, don't even require you to get the insurance, right? So what do you think the mortgage insurance is going to cover if I do, like, say, a 90% loan-to-value loan?
The 10% between the 90 and the 80.
It's going to cover the 10% between 80 and 90. Does that make sense for everybody? Because if I borrowed 80%, I wouldn't have to have insurance at all. So when I'm insuring it, I'm insuring only that amount above 80% loan-to-value. And I'm not buying the insurance because I want it, I'm buying it because the bank says I have to.
It's like, if you get past like the 20%.
Yep.
I'll give you an example. My son bought a house. He bought a house 6 years ago.
Yep.
He was one of the clever ones that bought one when the government was going to give you $5,000 back.
Yeah, the tax credit. Mm-hmm.
So, anyway, he has mortgage insurance on the house because he didn't have 20% to put down.
Right.
But I'm guessing at this point, the house would appraise high enough that he was probably, how would he go about proving?
So there's a way, and is it a conventional or is it an FHA?
It might be FHA, but I don't know.
If it's FHA, it never falls off.
Okay.
Yeah.
Really?
Yeah. FHA mortgage insurance never falls off. It's one of the downsides of the government-backed loans.
And
If it's a conventional loan, then there should be, in his note, a method of contacting the lender and proving that equity. He'll probably have to pay for an appraisal. And they probably will require him to show 22% equity. For some reason, that extra 2% makes all the difference in dropping the PMI early. Now, there is a scheduled date for the PMI to fall off, but he probably doesn't want to wait till then because it's probably like 11 years or something like that. But yeah, there is a method for showing that you have the equity and getting the PMI to fall off. I've had a lot of people in today's market, because the rates are so low, say that it's honestly easier to just refinance than it is to actually prove, because you can end up paying for the appraisal anyhow in the process of trying to prove you have the equity, and the interest rate you get right now is probably as good or lower than what you had. So a lot of people will just go the refinance route because they find it to be easier than actually trying to prove and get the PMI to fall off. All right. So does everybody understand the idea behind private mortgage insurance or mortgage insurance in general? Good. All right. We've already talked about loan-to-value ratio, so let's get right over that. Okay. A conforming loan. A conforming loan is one where it's on no more than 4 units, so 1 to 4 unit family residences only, and there's a maximum loan payment with a minimum down payment amount. Okay, the maximum amount is set based on your zip code. Each zip code has its own maximum conforming loan amount, and basically the maximum conforming loan amount is the maximum that FHA will allow you to borrow in that zip code. So whatever the maximum you can get on an FHA loan in a particular zip code, that becomes the conforming loan amount for that area. And the reason is that's the maximum loan they can sell to Fannie Mae in that area. And so traditionally speaking, you get better rates on a conforming loan than you would on a non-conforming loan, because the lender can sell a conforming loan to Fannie Mae, whereas a non-conforming loan they cannot sell to Fannie Mae. Most of you have heard of non-conforming loans, you just know them by their more readily accessible name, a jumbo loan. How many of you have ever heard of jumbo loan rates? Jumbo loans are non-conforming loans. It just means the loan is larger than the conforming loan amount. For example, in Wake County, the conforming loan amount is $417,000. Okay? So anything above a $417,000 mortgage amount in Wake County is considered a jumbo loan, which means they can't sell it to Fannie Mae. And that means it's generally going to have higher interest rates than its conforming cousin. So a lot of times, to avoid jumbo loan rates, what people will do is take out 2 mortgages. They'll do one for exactly $417,000 as a conforming loan, and then a second mortgage for the difference to avoid the jumbo loan.
Will the second one sometimes be a HELOC or something?
The second one might be a HELOC, home equity line of credit. It might be just a second mortgage with a little bit higher interest rate, but better to pay a higher rate on that small second mortgage than to pay a bigger rate on the whole amount. So lots of times, you don't really see very many jumbo loans actually written because they usually try to structure them to avoid doing that because of the higher rates. Does everybody understand what a jumbo loan is? Yeah, no, you're looking at me like I'm crazy.
Non-conforming loan that exceeds a certain amount.
Yes. Well, what?
It's just processing.
Okay. It's basically, Fannie Mae says, we won't buy loans that exceed this amount in this zip code. And the reason it's set by zip code is because it's set by the actual average price point in that zip code. For example, the conforming loan amount in Los Angeles is much larger than the conforming loan amount is here. In Los Angeles, I think the conforming loan amount's like $940,000. So Fannie Mae will buy mortgages up to that amount in those zip codes. So therefore, the lenders are pretty much free to lend up to that amount and know they can sell the loan to Fannie Mae. Here, they can only go up to 417 and know they can sell it to Fannie Mae. Anything above that, they either have to write it as a jumbo loan, which means they'd have to sell it to some other investor other than Fannie Mae, or more likely they break it up into two loans, one at 417, which they sell to Fannie Mae, and then another one, which will be like a home equity line of credit or something like that to bridge the gap. Okay? All right. So that's basically what you need to know about a conforming loan. Non-conforming loans could be jumbo loans. They could also be subprime loans. So borrowers don't meet the standards. That's also considered a non-conforming loan. Basically, anything that Fannie Mae won't buy is a non-conforming loan. Doesn't conform to Fannie Mae's guidelines, which means it's going to have, in theory, higher interest rates, because anything that Fannie won't buy is harder for the bank to get rid of. And so therefore, the way they entice investors to want to buy it is with a higher yield. Higher yield equals higher interest rate. Okay? So non-conforming loans usually have higher interest rates. All right. We talked about private mortgage insurance. It's required when the loan-to-value ratio is higher than a certain percentage, most likely 80%. The law does require PMI to automatically terminate if you have at least 22% equity in the property and you're current on your loan. And that usually is a set date. When you look at your loan, there's a set date for when that private mortgage insurance premium goes off. PMI is very expensive. Mortgage insurance in general is very expensive. It adds a significant amount to the monthly payment on the property. So be aware of that. If somebody does not have 20% to put down, they might consider going to a lender if they have access, like a state employees credit union who does a 100% loan product with no PMI, for example. See, there's your plug for the day. My first home purchase was a state employees, 100% arm. As we talked about with conventional loans, they're not backed by the federal government. If they are backed, it's going to be by private mortgage insurance. They are the most secure loans because they have the lowest loan to value and the highest credit of the borrowers. And they are going to be sold to Fannie Mae in the secondary market. Now let's talk about the first of the government-backed loans on page 313 in your book. In my experience, they give you a lot more detail here than you really need to know about the FHA and VA loan processes. Okay, so I'm going to try to pare this down somewhat for you and hit the high spots about these FHA loans. First of all, FHA does not lend money. Who lends the money in all these cases? The banks do. FHA is just mortgage insurance. It's the federal government's way of placing insurance on these riskier loans. And they are riskier because of a combination of two things. It could be one or the other, but it's usually a combination of the two. Lower credit requirements to obtain the loan, and more importantly, lower down payment requirements. And lower down payment just means higher loan-to-value ratios. So the FHA loan-to-value ratio, the maximum number you do need to know, okay? 96% 96.5%. Ignore all of those numbers that are down in number 2 on that page. The maximum loan to value for an FHA loan is 96.5% of the value of the property. That means your down payment is what? 3.5%. So 3.5% down payment. Okay? That's the advantage of an FHA loan. I can't tell you how many times you're going to have a client come to you and say, yeah, I'm doing an FHA loan, I'm going to put down like $30,000. Why? Why are you doing an FHA loan? Because if you're putting down $30,000, unless you're buying a $3 million house, that's a very significant down payment, right? If they're buying a $200,000 house, that's a 15% down payment. If they can do a 15% down payment, unless they have really terrible credit, they don't need an FHA loan. They will be much better with a conventional loan because the fees associated with a conventional loan are much lower than those associated with an FHA loan. Does that make sense for you guys? FHA loans are designed to be for those who cannot get other lending sources. The interest rates are very low on these government-backed loans, and that's because of the level of risk. Interest rates are tied directly to risk. FHA loans and VA loans are very not risky because of the government insurance. Does that make sense for everybody? That government insurance is not free though. Just like you buy private mortgage insurance, you buy mortgage insurance on the FHA loan. Who do you think you pay for that mortgage insurance? The government, because they're the ones providing the mortgage insurance. And they ain't cheap, folks. The mortgage insurance portion of an FHA payment is huge. The fees associated with getting an FHA loan are huge. The closing costs are huge. But here's the thing. If you don't have money for a down payment, what else are you going to do? And the answer is, for most people, nothing. It's the only choice they have. Okay? And that's the way you, as a broker, when you get out there representing your clients, should view these government-backed loans. There's nothing wrong with them, but they should be a last sort of resort for most people because they are very expensive from a fee standpoint. The mortgage insurance never goes away on an FHA loan. You pay it as long as you have the loan. Even if you've had the loan for 25 years and you only owe 10% on the property, you're still paying for the mortgage insurance.
Is it still called PMI there?
It's not. It's called MIP, Mortgage Insurance Premium. It's called MIP with them instead of PMI. Okay. They require the property to be appraised by an FHA appraiser. It has to be an FHA approved appraiser, which is a little bit different than other conventional loans, and their appraisal guidelines are a little bit different. One of the more interesting things about FHA loans, and you don't need to know this for the test, but just from a real world to show you what I mean by they have a little bit different rules. If a buyer goes and tries to purchase a home using an FHA loan and they have an appraisal done, that appraisal becomes locked in for 6 months on that property. So say it doesn't appraise and another buyer comes along and makes an offer and they're also using an FHA loan, you already know the property's what it's going to appraise for because that appraisal is now locked in place on that property for any FHA loan for the next 6 months. Whereas with a conventional loan, new buyer is a new appraisal. And sometimes appraisals can vary a lot from one appraisal to the next. And so that's a little bit different if you've had an FHA appraisal done on the property within the last 6 months, then that number's locked in. That's all they'll lend based on. Okay. Any questions about that? To give you an idea of how much the closing costs are on an FHA loan, they total up to about 3 to 3.5% of the loan amount up front. So on a $200,000 mortgage, you're talking about $7,000 in closing costs on an FHA loan, in addition to the monthly mortgage insurance premium that you pay. And the mortgage insurance premium is 1.5% of the loan balance. So That's not an insignificant amount of money. $200,000 loan, you're looking at about $7,000 in fees up front, and you're looking at roughly about $125 a month in mortgage insurance premium.
So, I mean, but the point of the FHA is, I mean, in part, is so that you don't have to you can make a much lower down payment, but like, if you're just transferring that to fees and,
That is where the magic of the seller-paid closing cost comes
I was
into
about to
play.
say, Yeah.
okay.
So that is another misnomer, just like the no closing cost loan. There's no such thing as seller-paid closing costs, because the seller isn't paying anything. Who's bringing all the money to a closing?
You are.
The buyer and the lender, right? Seller-paid closing costs is another way of saying I'm financing my closing costs. Because what you're doing is pumping up the sales price
Instead of paying up.
instead of paying it out of your own pocket.
Right.
So you're borrowing your closing costs. So that's what happens in FHA loans. Those fees get rolled into the loan and you end up borrowing more money.
Does the seller does assume some part of closing costs sometimes, don't they?
Well, we say they do, and it shows up on their side of the page. Yeah, it shows up on their side of the page, but again, who's bringing all the money to the closing?
We are, they're not. it's
Right?
not their
Like
right
one of the things we always say is the seller pays the commission because it shows up on the seller's ledger on the page. But I don't see many sellers writing checks at closing, right? I mean, if you think about it, realistically about where the money's coming from, ultimately, it all comes from the buyer side of things. And that's one, I think we get into lots of misnomers about things like seller-paid closing costs. And in theory, seller-paid closing costs shouldn't matter to the seller. What matters to the seller is the net number. You know, I can offer a seller $200,000 with no closing costs, or I can offer the seller $205,000 with them paying $5,000 in closing costs. It's the exact same number to them. But it's not the exact same number to my buyer, because my buyer, if I do $200,000 with no seller-paid closing costs, has to bring that $5,000 in cash to pay their closing costs. Whereas if we offer $205,000 with $5,000 in seller-paid closing costs, they're just borrowing the extra $5,000, and it might raise their payment by $20 a month, but they'd rather pay the $20 a month than pay $5,000 out of pocket. That answer your question? I know it's a long answer to your question, but that's how the money gets shuffled around to limit those closing costs. And FHA will allow up to 6% in seller-paid closing costs on their loans. So you can ask the seller to pay up to 6% of your closing costs. Up to 6% of the purchase price as closing costs. That's a lot. An awful lot. Which would, you know, in theory you could have it cover things like your inspections, your appraisals. I mean, literally every dime you had spent out of that transaction could be covered by seller-paid closing costs. Okay? The FHA loan program, let me skip past this. The VA loan program, so that's it for FHA. The VA loan program, all that extra mess they give you, the one thing I should point out, on page 314, in the middle of page 314, they talk about the different FHA loan programs. You don't need to memorize all of those. Isn't that wonderful? Mm-hmm. They've given them to you for reference purposes there, but they don't really make it clear that you don't need to memorize all those. What you do need to know is that the primary FHA loan is the 203B. When we talk about FHA loans, 99% of the time, we're talking about the 203B loan. That's the one for owner-occupied properties. That's the one, if I'm buying a house for myself and I don't own another home, I'm getting a 203B FHA loan. They do have other loan products available under the FHA banner. Like, for example, Title I loans would be for home improvements. I can do a home improvement loan through FHA. They have a rehab loan, which can be used for properties that are in terrible condition, where you actually get like you borrow more than the value of the property. And in order to do one of those, they have to send out their adjuster estimator ahead of time to estimate the cost of rehabbing the property, and they will put the excess money in an escrow account, and they only release it after you have used an FHA approved vendor to do the work, and they come and verify that the work's actually been done, and so you can use that loan to sort of rehab the property. that you're purchasing. So they have various loan products that do various things. They have one specifically for condos, for example. But what you need to know is the 203B is the standard, most common FHA loan, and there are other products that address other specific situations. Okay. Interest rates on FHA loans, they're not high interest rates. People have that misconception. In fact, sometimes they're lower than the interest rates on conventional loans. And that is also true of VA loans. Remember, interest rates are tied directly to risk. VA and FHA loans have very little risk for the lenders because of the government mortgage insurance. And so therefore they have very low interest rates. So that is one advantage of FHA and VA loans. Another advantage is that they are fully assumable loans. FHA and VA loans are, by law, fully assumable. Remember, we talked about loan assumption and what that is. It's when you have the ability to have somebody take over your loan. That can be very beneficial when you're selling a property that has an FHA loan on it. Because if interest rates go up significantly and you have an FHA loan, you know that that person can assume your loan, so that could help you with the sales process.
So they only just have to be able to qualify for a loan?
They have to be able to qualify for an FHA loan at that time. As long, whatever the qualification rules are at that time. In other words, if that person that wants to assume your loan could get a new FHA loan, then they can assume an FHA loan. So any borrower that qualifies to take out a new FHA loan qualifies to assume any existing FHA loan. Now, it's funny you ask that question. For loans made prior to 1989, there are no qualification rules. If you can find somebody who's got an FHA loan that's still in existence and was written prior to 1989, of course it would only have 3 years left on it at this point, anybody can assume it. There are no qualification rules. They changed that law in 1989, that you had to qualify under the current rules. Because it used to be anybody could assume an FHA loan. They found out that didn't work too well. Yeah, FHA and VA loans are fully assumable. VA loans, these are administered by the Veterans Administration, and coincidentally enough, they are there for veterans. These are only available to veterans and their qualifying spouses. Interestingly though, while you have to be a veteran to take out a VA loan, anyone who meets the loan qualification rules can assume a VA loan. You do not have to be a veteran in order to assume a VA loan. Now, that can be tricky for the service person whose loan you assume, because they only have an entitlement to one VA loan at a time. They can get as many VA loans as they want in their lifetime, but they have to pay one off before they can get another. Does that make sense for everybody? And if they allow you to assume their VA loan, then their entitlement to a VA loan is still tied up in your loan. All right? So they would be essentially giving up their right to take out another VA loan until you've paid off that one, if they allow you to assume their loan. So they'd have to weigh that out as to whether or not it is feasible for them. Here's the advantage, because largely the VA loan, I'm sorry.
You said them and their spouse, so can they have one and their spouse have one?
No,
Okay.
one. And so qualifying spouse would be a widower. A widow or widower
Okay.
of somebody who was killed in action, for example,
Okay.
would still have the VA eligibility in place. As long as the veteran themselves is alive, the eligibility is with the veteran.
Gotcha.
Okay. And you don't need to know, in your book they give you a lot about calculating how much of a loan they're entitled to. You don't need to know any of that. You do not have to know the math of calculating what their loan entitlement is for a VA loan. You just need to know that they're available for veterans and their qualifying spouses, that they can be assumed by anybody. The VA loan program is very similar to the FHA loan program. It's still government-backed mortgage insurance. There's one notable difference, and this is the reason why you do VA rather than FHA if you have the ability. FHA has a down payment requirement of how much? 3.5%. What do you think the down payment requirement is for the VA loan program? 0. There is no down payment requirement. And additionally, they will also allow you to roll all of the closing costs into the loan. They will loan 100% of the value of the property plus your closing costs. So it is completely a no cash out of pocket transaction on VA loans, or it can be anyway.
Are they able to like foreclose those homes?
Yes, they are absolutely able to foreclose on those properties. There is no distinction given other than the down payment, which is, you know, so essentially it's a free down payment, no down payment required.
Right, it's 100%, right?
100%. Now, they do have some special loan programs that, for example, if you have a service-related disability, they'll waive the mortgage insurance. The monthly mortgage insurance fee is waived if you have a service-related disability, but that's about the only thing extra that I've ever seen them do. I've helped a couple of veterans work through that process of getting the mortgage insurance portion waived. And then it's really a scream of a deal if you can do, you know, 100% financing without the mortgage insurance at a fixed rate of 3.5%. It's like, you know, that is free money for sure. All right, so does everybody understand the VA and FHA loan process? Again, who's making the loans? Banks. What is the federal government's purpose or role in those loans? Insurance. That's all they're doing, is providing insurance for those loans. They are not making the loans themselves. Okay, they guarantee the loans, which means that they are only involved in that portion of it. All right. We talked about FHA and VA loans. All right, so the last type of government-backed loans, and remember, what do we say government-backed means in this context of mortgage loans? Insured by the federal government. The federal government insures the lender against loss on the whole loan or on some portion of the loan?
Well,
Depends on the LTV.
The portion of the loan above what LTV?
Yeah.
80%.
80%.
Oh.
Remember, 80% is that magic number where if you borrow that or less, you don't need mortgage insurance at all, whether it be private mortgage insurance on a conventional loan or government-backed mortgage insurance. And if you're above 80% loan to value, you probably do need mortgage insurance. So FHA and VA loans follow the same rules pretty much. They both are fully assumable. They both are insurance programs that are administered by the federal government. What's the primary difference between an FHA loan and a VA loan? There are two primary differences. One has to do with who's eligible for them, and the other has to do with the loan-to-value ratios.
100%.
Which one's 100%?
VA.
VA is 100% loan-to-value loan. FHA is what? 96.5, exactly. And the eligibility, what's the difference there?
You had to be a veteran.
To take out a VA loan, you have to be a veteran or a qualifying spouse. Okay, we call that an entitlement to a VA loan. If you have met that criteria, you have an entitlement. Remember, your entitlement can only be used once at a time. So you can take out multiple VA loans, but what do you have to do before you can take out a new one? Pay the old one off. What can these loans be assumed?
Yes.
Yes, they're both fully assumable loans. Do they have prepayment penalties? No, they don't. By federal law, they don't. In fact, most loans don't have prepayment penalties any longer. Those are very rare nowadays. The last type of government loan-backed loan that we have not talked about is the USDA loan. And yes, that is the same United States Department of Agriculture that inspects your meat and your milk at the grocery store. Surprisingly enough, they're also in the home loan business. These are called rural development loans, and they're designed to create the ability for home finance in very undeveloped areas. They are for communities of up to 20,000 people. You don't need to know that specific number. You just need to know that they're available in rural areas only. So the VA loan program is one where the eligibility is tied to the borrower. Only certain borrowers are eligible for the VA loan program. The USDA loan program is tied to the property. Only certain properties are eligible for USDA loans. Now again, there's a difference between a USDA loan and an FHA loan. What do you think that difference is? What was the primary difference between?
100%.
It was the 100% financing. The USDA loan, the advantage of it for a borrower is that it's a 100% loan product. Doesn't require a down payment. So if you think of it this way, everybody is eligible for an FHA loan as long as you meet the minimum credit and income requirements. So anybody in this country can get a 96.5% loan-to-value mortgage. If you want to get a 100% loan-to-value mortgage on the government-backed side, now there are some private conventional mortgages that will go up to 100%. For example, like State Employees Credit Union will do 100% financing. But on the government-backed side, to get up to 100% finance, you either have to be a veteran and do a VA loan, or you have to buy a property that's in an eligible area and utilize a USDA loan. Does that make sense for everybody?
Yes.
Do you have to use it for like a farm?
I'm sorry?
You have to use it for a farm?
Do you have to use it for a farm? Absolutely not. There are not very many farms on Rock Quarry Road in Raleigh, but those are all USDA eligible homes. And most of them are financed using USDA eligibility. That will not be the case when the next census rolls around, because there's far too many houses out there. They set the eligibility for areas based on your census numbers. And so when the next census rolls around, that area will be far too developed to qualify for a USDA finance, and then it'll go away. There are very few areas left in Wake County that have USDA eligibility for those loans. Very few. And the ones that do have it will probably go away at the next census.
And you said this could be 100% funded?
Yes, the USDA loan program is 100% financed. Same thing is true. Same thing is true in that you are generally not having the government loan money. The banks are lending the money. There's a little bit of a difference here, though. The USDA loan program can actually be a direct lender. That never happens in FHA loans or VA loans. In FHA or VA loans, it's the banks doing the lending and the government's just doing the insurance. In the USDA loan program, because it's targeted at very rural areas, if you are more than a certain number of miles away from an eligible lender, then the government will allow you to directly apply to the USDA and have them lend the money directly to you. Basically, they don't want to create a hardship if you're in the middle of North Dakota somewhere and it's 300 miles to the nearest lender. You can go and apply directly with USDA and they'll fund the loan directly. But for the most part, these are still done through the same lending channels that all other loans are done through.
They work with BB&T and send people, like in the Amish areas, in there to take care of their loans and banking, since they don't like support like the internet and stuff for the loans.
Right, that makes sense. But you can do a USDA loan through most any bank, or any mortgage broker can handle a USDA loan. They're not terribly different than any other loan as far as the qualification process. They do have some quirks about them, like for example, in a USDA loan you can't make too much money. And most other loans, they want to make sure you make enough money. In the USDA loan, they want to make sure you don't make too much money. They have minimum and maximum incomes for USDA loans, which is a little bit different. Okay? Types of mortgages that you might come across on a test. And I'm going to try to narrow this down to the ones I think are most likely. The first one, you will definitely see some reference somewhere on the exam to a purchase money mortgage. A purchase money mortgage is seller financing. A purchase money mortgage is seller financing. That's all it is. Sometimes you might see it phrased as the seller is taking back a mortgage for a certain amount. When you see that phrasing, the seller is taking back a mortgage, that's also seller financing. Okay? Let's see, what else on here might you see on the test? Construction loans. Construction loans are likely to be seen somewhere on the exam. Construction loans are exactly what they sound like. They're loans that are designed to help you construct a property and finance that construction. That's a very different process than the traditional mortgage loan. If you think about a traditional mortgage loan, they're lending in one lump sum on a property that is completely constructed already. And so the entire loan is funded all at once. The lender is taking a very small risk because if the borrower stops paying, the lender has something they can tangibly foreclose on and take and sell. Think about the risk associated with a construction loan. If the borrower stops paying and the property has not yet been completed, it's very hard to foreclose and sell something that's partially done. Does that make sense for you guys?
Mm-hmm.
So, construction loans are much more risky for the banks, and that's what you need to know about them. You need to be able to rank. Sometimes they'll ask you questions, which of the following loans carries the most risk for a lender? Well, if a construction loan is included in that, that's always going to be at the top of the list. So let's rank the loans in order of risk. If you had conventional mortgage, 80% loan to value, FHA, construction loan, which of those is the most risky? Construction, which is the least risky? The conventional with 80% loan to value. Now see, people get confused about that. They say, oh, but the other one's got a government guarantee. Remember, the government guarantee only kicks in above 80% anyway, right? So there's still more risk associated with insuring more than 80% loan to value than there is in just having less than 80% loan to value in the first place. Does everybody kind of follow that line of thinking?
Yeah.
So of those, the conventional with an 80% loan to value is the least risky, and then the construction loan the most risky. A sale and leaseback. This happens a lot in new construction neighborhoods. A sale and leaseback is when the property is sold and then that seller, the seller leases the property back from the buyer for a specified amount of time. Builders do this all the time in new construction neighborhoods. Very often, if you go into a model home in a neighborhood, how many of you have ever been into a model home and walked around? That home is most likely not owned by the builder. It's likely already been sold to its eventual owner and leased back for several years after the fact. If you think about it and you're an investor, that's not a bad deal. If you can buy what's going to be the nicest, because you've been in a model home, you know it's the nicest home in the neighborhood, right? It's got all the bells and whistles, all the upgrades. So you buy that from the builder, probably at a reduced price than it would be if you bought it with all those upgrades just straight up, and you lease it back for 2-3 years, and you can come in there and sell it and make a profit at the end as well. So it's not a bad deal. So sale and lease back. The builders like it because it doesn't tie their money up in the house for a period of 3 or 4 years. All right. We talked about buy downs, home equity lines, over on page 320. Now, home equity line, what did we say equity was?
The difference between the LTV and to the 100%. It's the part between the LTV and the.
Yeah, right. It's the difference between my loan-to-value ratio and the value of the property. The difference between what I owe and what it's worth is my equity. Everybody got that? My equity is the difference between what I owe on the property and what the property is worth if I sold it. That amount, that money that I would put in my pocket, presumably, if I sold the property, that's my equity in the property. So a home equity line is simply tapping that equity, borrowing against just the equity you have in the property. So for example, if I have $50,000 worth of equity in my home, I might want to borrow some additional money, maybe to do a home improvement. I might go to a lender and take out an additional loan in addition to my existing mortgage and borrow against that equity in the property. That's a home equity line. Okay? And then our good friend, the reverse mortgage, which is always on television in various commercials. I find it funny that they're still using Fred Thompson, who's been dead for like 5 years, in the reverse mortgage commercials. And a law President Reagan signed into, I've heard that commercial a million times. So, reverse mortgages. What happens in a regular mortgage? Let's talk about a regular mortgage. Give me the process. I apply for the mortgage. They give me what?
Money.
Money in a big lump sum. and I give them money back in what form? Small payments monthly. Well, a reverse mortgage, we do it the opposite way. Instead of them giving me money in a big lump sum, how do they give it to me? In little dribs and drabs and monthly payments. And then at the end, what do I have to do? Give them the big lump sum of money back, or give them the property, one or the other. Most reverse mortgages are set up that they end in me turning the property over to the lender at the end of a certain amount of time. These are a way that people can basically structure income draws from their equity in the property. Rather than borrowing it all at one time, they can do it in a structured way, and they only pay interest on the money they've actually drawn out, which of course escalates as time goes on. And basically a reverse mortgage is sort of a gamble against when you're going to die. You know, the gamble is that your equity will run out before you do, so to speak. And that's not a good situation.
And is that product sold by insurance companies?
Yes, it is. And that's why it's called a reverse annuity. It is sold as an insurance type product. It sort of crosses the barrier between mortgage and an insurance product. It's sort of half and half. Some of them are done by insurance companies, some of them are done by mortgage companies, but there is some crossover there, for sure. Okay? We talked about purchase money mortgages. Again, this is just seller financing. It's owner finance at the time of purchase. The owner takes back a note for part of all of the purchase price, becomes a lien on the property. And in North Carolina, remember we mentioned that the seller is not entitled to a deficiency judgment in seller financing. What is a deficiency judgment?
When the bank doesn't get all of their money by foreclosing, so that they can then attach a lien against you.
That's exactly right. Did everybody hear her answer? She said the bank forecloses and they can't get all their money by selling the property, so they didn't come after the borrower personally for a separate lien for the deficiency, the shortfall. Exactly right. And if you do purchase money mortgages or seller financing in North Carolina, you're not entitled to. I think you asked a question about that last night, right? Okay. We'll skip over those. We just talked about them. Just talked about the equity loan. We talked about the reverse annuity. All right, mortgage priority. Mortgage priority. The first mortgage or senior mortgage is the one that's going to be paid first. Now, all mortgages, where do they fall in line in the payment of things? After what? After taxes. And what else is also ahead of them? The special assessments. And if it's a foreclosure sale, what else is ahead of the mortgages? The cost of the sale. Don't forget that. In a foreclosure sale, cost of the sale actually come first, right? And then taxes and special assessments. And then mortgages in the order that they're recorded. We don't call something the first mortgage or the senior mortgage because it's the biggest one. That's not necessarily true. That's usually true. But you could have the first mortgage be a smaller mortgage. It's called the first mortgage because it's recorded first. And that order matters because these mortgages are going to be paid off in the order that they're recorded. If you're a second mortgage, there's higher risk there, simply because of getting paid later on in the game. The second mortgage is always more exposed than the first mortgage is. This is one of the difficulties you run into when you start talking about a short sale. You guys remember when I mentioned short sales last night? What did I say was happening in a short sale transaction?
The bank was taking less money than they were owed for the house.
The bank is taking less money than they're owed and they're removing their lien from the house, right? That's a short sale. The bank is agreeing to let the seller sell the property and satisfy the lien for less than the bank is owed. They're removing that lien in spite of the fact they're not getting all their money. That becomes about 1,000 times more complex when you have two lien holders that need to sign off on the thing. Because here's what can happen. An offer comes in that would satisfy the first lien holder completely, but maybe only get the second lien holder 10 cents on the dollar. You know, let's say there's a second mortgage out there for $50,000, and the second lien holder is only going to get $5,000, whereas the first lien holder of $200,000 is going to get their entire lien settled. Well, is the first lien holder going to say okay to the short sale?
Sure.
Absolutely, because they're getting paid. What's the second lien holder going to say?
No.
Well, and some people would say, well, why are they going to say no? It'd be even worse for them in a foreclosure. Maybe, but they have leverage. Because who does it get much worse for if it goes to foreclosure?
First mortgage.
The first mortgage. Because the first mortgage is in good shape right now. But if that thing goes to foreclosure, could the first mortgage take a hit too? Absolutely. And so if I'm in second place, I go, no. We don't want 5,000 on our 50. We want 15. Well, where's the other 10 going to have to come from?
First mortgage.
From the first mortgage agreeing to accept less on their note as well. And what's the incentive they have to do that? Because they're afraid it would get worse than that if they let it go to foreclosure. You see how complex that negotiation can become when you've got Chase on one hand and Citibank on the other, trying to fight over $10,000 in this thing, and it happens all the time. Short sales with one lien holder are easy. Unfortunately, very few of them have one lien holder. They almost all have two, and then you end up in these fights between the two lien holders.
So if you have a first mortgage and then a home equity line of credit, you pay off the first mortgage, does the second one become the first mortgage?
It does. It does. That's a really, did everybody hear that? That she said, if I have a first mortgage and I have a HELOC, a home equity line of credit, and I pay off my first mortgage, is my HELOC now my first mortgage? So in other words, if I go out and get another mortgage, is that second one going to now be my second mortgage? And the answer is absolutely, because it was recorded in that order. But look at the top of page 321. On the top of page 321, it talks about something called a subordination agreement. Most of the time, if you go out and you try to refinance that property, nobody's going to give you a refinance on that property unless that home equity line agrees to sit in second place. So they basically, you're asking your home equity lien holder to give up their first place position, to sign something saying they agree to sit in second place to this new mortgage that was just filed. And in most cases they will, because they were in second place already anyway. In most cases, and a lot of times your HELOCs already have some language in there that guarantees that they'll sign a subordination agreement up to this amount. You know, that they'll allow you to go out and refinance and take out another first mortgage up to this amount, and they'll agree to sit in second place behind it. But you're going to have to get that, or that other lender's going to say, close out that home equity line first. You know, they may say, we'll refinance it for you, but you got to use the proceeds of the loan to pay off the home equity line and close it out. So closing the home equity line would, in some cases I've seen them where the lender would not sign off on the subordination agreement. They wouldn't agree to sit in second place. So you know what the borrower did at closing? They had two closings. They had one closing where they refinanced with a primary mortgage loan and used those proceeds to pay off their existing home equity line. And then they immediately had another closing on a new home equity line that happened to be for the exact same amount of money. So they basically paid off one HELOC and took out a second one, but now that second one was behind the other mortgage in line. Does that sort of answer your question there?
Because that's the position we're in right now.
Yeah. So it gets handled in one of those two ways. Okay. The application process. Now, when you talk about the application process, some of the things have changed, and we won't see as much of it in Chapter 14. When we get to Chapter 15, some of the information has changed in some of these laws, particularly things that refer back to the lending law and the closing laws. We'll talk about the new paperwork, and I'll point out the changes where they've happened as we come across them. So the loan application process, how do we apply for the loan? Well, when you apply for a loan, there is a trigger that causes the lender to have to disclose to you what the terms of that loan are going to look like. That happens at the time of loan application. And within 3 days of loan application, the lender has to give you something called a loan estimate. Now on my slide up here and on your slide in your book, it says good faith estimate. I want you to put a line through that and write loan estimate. That's the new federal law in the new form. It's simply called the loan estimate.
So is that 3 business days or 3 days?
3 banking days. 3 banking days. And banking days count Saturdays if you want to really know. According to the federal law, Saturdays count as banking days. And we'll talk more about that process in chapter 15 with closing the transaction, but for right now, know that within 3 days of loan application, the lender has to give the borrower a loan estimate, which basically outlines all the charges, origination fees, discount points, estimations of closing costs, what the monthly principal and interest payment would be. All of that information has to be on a loan estimate, which goes to the borrower within 3 days of loan application. And they cannot deny you for a loan deny you getting a loan unless it's in writing. Any denial has to be in writing. Yes?
What did you say the name of the estimate was?
Loan estimate. I think they changed it from good faith estimate because there wasn't much good faith going on. So they just made it more blunt. It's the loan estimate. So in the underwriting process or the process of obtaining a loan, the borrower is going to go through a qualification process. And we're going to talk about that qualification process, and then we're going to talk about the math of that qualification process as well. So borrower's credit history is going to be looked at, their income is going to be looked at, their assets are going to be looked at, and also their existing debt is going to be looked at. The lender's going to take all of that into consideration when they choose whether or not to issue credit to this person. Now, as we talked about last night, where are most of those guidelines coming from at this point in time? From Fannie Mae. And why are they coming from Fannie Mae and not the banks themselves?
So they can be bought.
So they can be sold, exactly right. Because Fannie Mae is saying, we will buy loans that meet this criteria. And the banks only want to make loans that they can sell. Do you have a question, Sabrina?
Yeah, but we can.
You sure?
Yeah.
Okay. All right. Also part of the underwriting process is qualifying the property, making sure it appraises. What does that mean to make sure it appraises?
It meets the loan.
It meets the value of the loan.
Yeah.
They're not lending too much against the property to make sure that if they had to foreclose, there'd be enough value in the property there to get their money out. Okay? So this is where your question comes in, Leanne. Earlier, you asked about it was the lower of 2 numbers. When we talk about loan-to-value ratios, the loan-to-value ratio is actually going to be the lower of either the purchase price or the appraised value. So the appraisal is going to dictate how much money the lender will actually lend. That's really important in today's environment. In today's environment, we have lots of properties that don't appraise because it's such a competitive environment. The buyers are driving the prices up so quickly that the appraisals can't account for that kind of demand, you know, because the appraisals, remember, the appraisal process is looking backward in time. The appraisal process is taking things that have closed and comparing them to this property right now. Well, in an increasing market where basically every sale goes at a higher number because of the competition, appraisals have a hard time keeping up with that kind of ramp up in prices. Does that make sense for everybody? So it's very common in today's market that properties don't appraise for the purchase price. In that case, when that happens, the lender's not going to lend, say, 80% of the purchase price. They're going to lend 80% of which number?
Appraised.
The appraised value. What if the property appraises for more than the purchase price? What are they going to lend?
The lower amount.
80% of the purchase price. The lending is always based on the lower of those two numbers. So if you have an appraised value that's lower than the purchase price, the loan-to-value ratio is based on that. If you have an appraised value greater than the purchase price, the loan-to-value ratio is going to be based on the purchase price.
Does the appraiser have some idea what the purchase agreement is?
They not only have some idea, they have a copy of it in their hand when they go out there to appraise the property. They certainly do. Not that that gives them a target to hit or anything.
But,
No.
well, I'm about to wonder because we bought a lot of houses. And the appraisal always comes in, if it's a good appraisal, it'll come in $300 over what you're trying to buy the house for. I mean, just, and so you.
Magic, ain't it?
You know, it's usually above, but not so far above that, you know, it's a magical big number.
Yeah. I have clients to this day that'll still say, oh my gosh, it appraised for exactly what I'm paying for it. That's pretty awesome. Yeah, it might have something to do with the fact that the appraiser had your sales contract in their hand when they were, hard job, isn't it? Let me go out here with an assignment to put a value on this house, and I've also got a copy of the sales contract with me in my hand where I see what the buyer's willing to pay for it. I don't understand it. I never have understood it. I've asked 1,000 appraisers and I've got 1,000 answers that are tiptoeing around the tulips, but nobody can adequately address to me why the appraiser needs a copy of. And here's what I always say to them. You're supposed to know more about value than I do because that's just your job. Appraisers are trained far more in value than real estate brokers are. When I do a CMA on a property, I don't have a sales contract with me to come up with a value. I've got to look at the comps and the numbers in the real world and base my value opinion based on that. You, who are supposed to be the utmost expert, need the dadgum sales contract in your hand to be able to come up with a value. Why is that? Well, you just don't want... No, I don't understand. You're right.
But then, quite frankly, a house is worth what somebody's willing to pay for.
Yes, I
And
completely
so,
agree.
if somebody's willing to pay worth $180,000 a house,
Yeah.
that's what it's worth.
Especially if there are multiple somebodies willing to pay that. And that's one of the maddening things right now in the market. Every once in a while we'll get an appraisal back. Say you're the listing agent on something and you have 4 or 5 offers, which is not uncommon right now. And all of them are above $180,000. The lowest one's the 180, the highest one's 185. So you accept the 185. The appraisal comes back at 176. And you go to the appraiser and you say, here are 5 offers. All of them are, now I understand if you want to go with the lowest at 180, but they're all above. What's the job of the appraiser? To predict what the market is doing, right? So sometimes you get that one where you're just like completely just blown away. Your brain wants to melt out of your ears because you can't understand how it could possibly appraise for such a low number when you clearly have the demand at a higher number. But the appraisal process can be a maddening one from a real estate broker's perspective for sure. Okay? So we want to talk about the biggest part of qualifying the borrower outside of their credit score. Credit score is a big part. And let me just give you something real quickly about credit score. The biggest misconceptions about credit scores are some things that you're going to run directly into as a real estate broker. Number one, it does not hurt your credit to check your own credit score. It just doesn't. I don't care if you check it every 3 minutes. It doesn't hurt your credit to check your credit score. Now, there is another huge misconception. I don't want to go apply for a mortgage in a bunch of different places because I don't want a bunch of credit pulls on my credit record. It's going to hurt my credit score. No, it doesn't. 1 is the same as 1,000 when it comes to credit pulls for the purpose of getting a mortgage. The way the credit scoring models are set up, when you have your credit pulled to try to obtain a mortgage, you've opened a 30-day window where all credit pulls for that same purpose count as 1. Does everybody understand what I just said? Mm-hmm. So it's done like that under federal law specifically as a protection for borrowers so they can shop around for loans. It does not hurt your borrower's credit to go apply for mortgage loans in multiple places. Now here's what can really hurt their credit. They apply for a loan this month and they didn't get it, so they go back next month and they apply for a loan again. Is that within a 30-day window? No, and that counts as a new credit pull. And so you can get somebody with a bunch of credit pulls like that, and that does hurt their score. But it does not hurt their score. I've had people who resist it to shop, you need to go shop that around, you need to check it. I don't want to do that, it's going to hurt my credit. No, it won't. I promise. I promise it won't. Also, there are the best advice you can give your clients about credit is to not do anything related to their credit after they've gotten a pre-approval and until they've closed. Nothing. Don't put anything on a credit card. Please don't buy a car, a boat. Don't do this, and this sounds so counterintuitive. So this is what I mean by don't do anything. If you had your lender pull your credit score when you applied for a mortgage loan and they approved you for it, and they provided you with a copy of your credit report and said, yeah, the only thing on here is some collection account from Time Warner Cable from like 12 years ago, for $200. But we're not worried about that. Now, certain people who are really concerned about their credit might go and try to contact that lender and figure out if that's a legitimate debt and pay it, right? No, don't do that. Because if you pay something that's 12 years old on your credit report, it is as if that delinquency happened today. Paying it off, as counterintuitive as it is, actually makes it a current default on your credit report, and it can disqualify you from that mortgage loan. I've seen it happen. So the best advice you can give to your clients is, if they have been pre-approved, don't touch anything. Don't buy anything. You pay cash for your groceries. You pay with your debit card for everything. You don't do anything related to your credit until we get closed. Don't buy furniture. Don't, nothing. Nothing. If DirecTV wants to run your credit to set the NFL Sunday ticket up, no. Wait till after you're closed. I'm telling you, because you never know what one last credit pull can do. And it could put you right over some cascade into the land of either not qualifying or qualifying for worse terms all of a sudden. So the best advice you can give to your clients is just stay still. Right there. Don't pay anything off. Don't charge anything. Don't go either way. Just sit where you are and tread water for a month. In good shape, qualified, let it be. One time in my career, I had a buyer pull up to a closing in a brand new Mercedes. And I got out of my car, and I didn't realize it was her until she got out of the car right behind me. And she said, hey, good morning. And I turned around, and I looked at her, and I looked at the car. And I'm thinking to myself, please tell me that's not your car. And she goes, you see what I got? I'm like, oh, damn, it's your car. And I said, oh, you got a new car, huh? She said, yeah, they were doing a special now, 0% finance. And I'm just like, oh, God. Because what we're about to talk about is something called a debt-to-income ratio. A debt-to-income ratio is very important in the qualifying process. It's equally as important as making sure somebody's credit score is high enough, is making sure that they have enough income to justify paying off this loan with the monthly payments every month. And it's not just the amount of this loan that we want to look at, it's the amount of this loan plus the amount of all their other debt taken into consideration. So, could buying a brand new Mercedes change your picture as far as debt to income ratios, do you think?
Yes.
Yes, absolutely. To give you the synopsis of that closing, I would love to tell you that I am completely 100% ethical at all times, but I went in that closing, and at some point during every closing there's an affidavit that the buyer has to sign. And that affidavit says that their credit position has not changed from the time of loan application. Now, your lender has the right to pull your credit again on the day of closing, and often they do. Sometimes they don't, Sometimes they do. They always pull it within a week of closing. She'd just gotten the car the day before. Apparently they had already pulled her credit because it had not hit her credit report yet that she had applied for a car loan and indeed taken out one. And so when the attorney pulled out that affidavit letter that says, your credit position has not changed since the time of loan application, I spun around in my chair the other way, like, I don't want to hear this. I don't want to be a part of this. Should I have said something? Yes. Did I? No. I am human. Yes, ma'am.
Okay, this is where my question sort of applies. For commission-based jobs, how do they verify income?
So that's a good question, and it's going to be one that for the rest of your life will be a challenge if you stay in real estate. For commission-based jobs, how do they verify income? Well, they generally want to see 2 years worth of tax returns to verify income, because they cannot verify your income with pay stubs in the same way that they do with a W-2 job, because your pay stubs are an adequate reflection of your take-home income in a W-2 job. Whereas with a 1099 or a self-employed, independent contractor type profession, your tax returns are more indicative of your take-home money. So in most cases, they will want to see 2 years worth of tax returns, which means sometimes you may be in the business for 3 years before you can actually go out and use that income to apply for a loan, because 2 years worth of income, then get your returns filed, you're 2.5 years down the road.
And what happens if two people, like if you're married, and one person has really bad credit and one person has good credit? Does the bad credit pull down on the good credit when you apply for a mortgage?
It can, yes, absolutely. So what happens often in situations like that is the lender may suggest only one of you being on the loan. However, you can't have your cake and eat it too. If you knock one spouse off of the loan because they have bad credit, you've also eliminated their income from consideration for the loan. And so sometimes you run into this conundrum. The one who makes the money has bad credit. The one who doesn't work has great credit. That's not very helpful in the lending world. It's more common than you might think, though. Because here's what happens. You have one spouse working, and he or she pays the bills poorly, right? So they have the income, but they also have the dings on their credit because everything's attached to their Social Security number and they miss paying bills all the time. The other spouse has great credit, but they don't have any income. It's going to be very hard to get them qualified for a loan.
And the last one, I went to a car dealership just to look some stuff over and talk to them, and they said that medical bills only stay on your credit for 7 years. Is that true?
That's true, for the most part. For the most part.
That is why my credit stinks, is medical bills.
Yeah, for the most part. And different lenders have different criteria about sometimes they will even excuse them, closer than 7 years. But that's on a case-by-case basis.
Yeah, it makes me mad because my boyfriend's dad is a doctor, so I can't talk to him about it because he gets really upset about medical stuff. But going to the doctor to get antibiotics for an infection should not cost $3,000.
That's a big deal. Yeah, that's a big deal. So, but yes, they will. You definitely can have one partner's credit sort of gum up the works for both in that case. It works out pretty well if you have one who has sufficient income and good credit that you can just eliminate the other one and have only one partner, spouse be on the loan while they're both purchasing, because you can go that route. Okay? So we want to talk about the math of pre-qualifying buyers. And in conventional loans, we use something called debt-to-income ratios of 28% and 36%. Now, at this point, I'm going to depart from the slides and depart from the book, because I sort of feel like the book does a poor job of explaining to you what's going on. So I've got a little packet of information here on buyer loan qualification. And I want to have have you guys learn how to qualify a buyer based on their debt to income ratios. So the best way to think of a debt to income ratio is to sort of think of it as a bucket of money. And the borrower has a certain amount of income. That's how much money is in the bucket. They can't afford to spend all of that income on their house payment. Because clearly, if they're spending 100% of their income on their house payment, how do they afford to go to work? Right? You kind of need a car, and you have to put gas in it, and you have to eat occasionally, or a lot if you're me. You need electricity, you need utilities, you need a lot, you got to pay taxes, right? You can't afford to spend 100% of your income on anything because some percent of your income is going back to taxes, to income taxes. So is it fair to say, for all of you, that any borrower can only afford some percentage of their income to be devoted to their house payment? Does that make sense to say that to you guys? That no matter who the borrower is, no matter what their financial position is, they cannot afford to pay 100% of their income as a house payment. Is everybody with me on that? Because I think if you get that basic idea in your head, you start to understand how debt to income ratios work a little bit. So when we qualify a buyer using a debt to income ratio, what we're trying to do is determine what percentage of their income is a reasonable amount for a borrower to be able to spend on their house payment. Do I need to repeat that for you guys? Everybody good with that? So the lender gets to set that percentage. The lender is going to be the one that comes in and says, we're comfortable giving you a loan as long as you're not spending more than whatever percentage on your house payment. Why does the lender get to set the rules?
They're the one giving the money.
It's their money. It's their money. If I'm loaning you money, I get to decide what makes me comfortable with you. So if I'm the lender, am I more comfortable with you spending 25% of your income on your house payment or 30% of your income on your house payment?
25.
25. Because somebody spending 25% of their income on their house payment is more likely to be able to make that house payment and repay that loan. Everybody follow that line of thinking?
Yes.
Okay? So from the lender's perspective, we want somebody's debt to income ratio, that's what that means, is the ratio of their debt to how much they make, to be lower if possible. That's better from the lender's perspective. The lower your debt to income ratio, the less of your monthly income that you're spending for your house payment, the more safe that loan is. Everybody follow that line of thinking? Mm-hmm. So that's the first test we have to do. Make sure the house payment itself isn't too much money. We're not done yet though. We also need to look at all the other debt this person has taken on and make sure the combination of the house payment plus all this other debt is not too much that they can't handle it. So the lender's actually going to have a couple of different qualifying ratios in play here because they're going to check two different things. Number one, they're going to check to make sure the house payment itself is not too much. And number two, they're going to check to make sure the house payment plus all the other monthly debt is not too much. Does everybody follow that line of thinking? Okay? So the traditional qualifying ratios, if I don't fall down, are 28% of gross monthly income. So what does gross mean? Before taxes. Okay? And this is for our housing expense. Which is a fancy way of saying house payment. Right? What we mean by that ratio is that the lender is comfortable with us having a house payment that is 28% of our gross monthly income or what? Less or more? Less. The lender's comfortable with us having a payment, house payment, of 28% of our gross monthly income or less. Anything lower than that, they're fine with. If that house payment we're trying to qualify for is more than 28% of our gross monthly income, what is the lender going to say to the loan?
No.
No. They're going to deny the loan. Fair enough?
Yeah.
Now, if that one works, if that test works out, then the lender's going to come back and say, okay, we also don't want you spending more than 36% of your gross monthly income. On your house payment, so your housing, plus all other recurring debt. Let's talk about that idea of recurring debt. Recurring debt is something you make payments on. Something that has a minimum monthly payment. Something that's structured to be paid over a long period of time. Money you owe to people. It's not bills. Your electric bill is not recurring debt, because you can stop using electricity at any time.
So like a car.
Car payment, absolutely recurring debt. Student loans, absolutely recurring debt. Credit cards, absolutely recurring debt. But on credit cards, it's only going to be what payment?
Minimum.
The minimum payment is going to be calculated for credit cards. Not what you actually pay, but what the minimum payment is on those cards on a monthly basis. Car payments, credit card payments, student loan payments, medical bills if you have a structured monthly payment for that. All of that is considered recurring debt. Any kind of dues, association fees, none of that is part of recurring debt. Utility expenses, that's not part of recurring debt. Is everybody with me so far on that? So, which one of these ratios do you have to qualify under for the loan to be a yes, to get a go?
Both of them.
Both of them. You got to spend no more than 28% of your monthly income on the house payment, and you got to also spend no more than 36% of your monthly income on the house payment plus all the other debt. Does that make sense for everybody? Now, in your packet of formulas here, I believe I gave you one for this.
You did.
I did, which is on page 8. So if you turn to page 8, and I'll throw it up here on the screen again. This is your T-bar for determining maximum affordability. How much someone can afford to spend on a monthly basis for their house payment is using this formula right here. So we want to take a look at doing one together. And I'm just going to make one up here on the board and we'll go through it together. All right? Let's say that Travis is trying to apply for a mortgage loan, and the mortgage loan he wants to apply for has a principal and interest payment of $1,856 per month. Okay? Principal and interest payment of the loan I want to qualify for has a payment of $1,856 per month. Now, I have an annual income of let's say, $120,000 a year. Okay? Annual income of $120,000, and then I have some payments I make every month. I have a credit card bill, $600 a month. I have a car payment of $800 a month. I have student loan payments. $1,000 a month. And my question is, does Travis qualify for this loan using the traditional qualifying ratios of 28 and 36? Now, which ratio did I say Travis has to qualify under to check to see if he qualifies for this loan?
Both.
Both. So we may as well start with the 28% side of things, since we got to do both. On the 28% side of things, that's also sometimes called the front end ratio, and the 36% ratio is called the back end ratio in lender speak. What expense is tied to the 28% side over on the board over there? The house payment. Okay? Now, so let's talk about real quick what housing expense would be. And of the things on the board here, what things are housing expense? Just the monthly PI payment. How about if they had taxes and insurance? If they gave me like annual taxes and insurance, is that part of my housing expense? Yeah. So I would need to break those annual taxes and insurance down into a monthly charge. Does that make sense for you guys? And add that together with my PI payment. Would my HOA fees count in my housing expense? Yes, they certainly would. That's all part of my housing cost. So on the 28% side, I'm looking for my total housing expense, and I'm looking for my gross monthly income to determine my maximum affordability. So we want to check it and see if we can afford it here. We're looking for the maximum affordability. How much of a payment can Travis afford? What does the T-bar say do if we're looking for the maximum affordability? It says we're going to multiply gross, what kind of income? Monthly income times the, not times the, what'd you say? Oh, you said the ratio. Okay, I thought you said a number that was not that number. You said the qualifying ratio. Yes. And in this case, what ratio are we using?
28.
28. All right. So we want to take our gross monthly income, but they didn't give us that, did they? What did they give us? Annual. So we need to convert that to monthly. Divided by 12 is $10,000 a month. So T-bar says take our gross monthly income of $10,000, multiply it times qualifying ratio of 28%, and what's our maximum housing affordability? $2,800. So let me ask you this question. I can afford up to $2,800 for a house payment. Am I okay so far with my $1,856 house payment? Do I qualify for this loan so far?
Yes.
So far, yes, I qualify. Does everybody agree with that?
Yep.
Good. Now, we also got to check the 36% side. The formula stays exactly the same. My gross monthly income stays exactly the same. But now what am I multiplying my gross monthly income by?
36%.
36%. So what can I afford for my housing plus all my other debt? $3,600 per month. Now, in order to check and see how much of a house payment that entitles me to, I need to get rid of my other debt expenses. Does that make sense for you guys? Because this is my maximum affordability for housing plus all my debt. I only want to see how much house payment I qualify for. So what do you think I need to do with this $3,600?
Subtract the debt.
The car payment and credit card.
Subtract the debt, right? So, how much is my car payment? $800, right?
I'm sorry.
My credit cards are $600. My student loan is $1,000. So So I'm taking a total of $2,400 out of there, right? Which is going to leave me with $1,200. Now, is the lender comfortable with that loan any longer?
No.
No, because there's the maximum I can afford based on my monthly income for a house payment and stay within this 36% ratio is how much money? $1,200. Does everybody understand that? That's the most I can afford according to the math here. And the payment that I'm trying to apply for is too much. So is that loan going to be approved or denied?
Denied.
Denied. Denied. Look in your book on page 324. On page 324 in your book, I'll take the slide down here about maximum affordability. We've got loan factors. I sort of messed up and gave you a loan factor question by accident earlier on your quiz, but I cheated and gave you the payment. Loan factors are really simple, and for some reason, people try to make them more complex than they are. A loan factor is a cheat sheet. In the dark ages, when I started in real estate, we didn't have a computer in our pocket. You didn't have access to the internet at all times or an app that you could just churn out a mortgage payment. What we had was a little thing in our pocket with like a slide, and you'd set it on a certain interest rate, and then there was a wheel at the top, and you'd turn it to 15 years or 30 years or 20 years, whatever the term of the loan was, and it had a little red plastic window in the middle, and that number that was in that red plastic window was what's known as a loan factor. A loan factor is just a payment, a PI payment, per $1,000 borrowed. So in other words, if you only borrowed $1,000, your payment is that number. If you borrowed $2,000, your payment is twice that number. If you borrowed $3,000, your payment is 3 times that number. Now let's get some big numbers. If you borrowed $100,000, your payment is 100 times that number. If you borrowed $250,000, your payment is 250 times that number. You see how simple this is? Don't make it more complex than that, folks. It really is. Loan factors are just that simple. It's a payment per 1,000. So if somebody wants to know how much their payment is going to go up between a $200,000 loan and a $210,000 loan, how many multiples did it go up? 10, right? It only went up 10 multiples. Does that make sense? Because it's a payment per 1,000. So all you need to know is multiples of what number. That's where the chart comes into play. Look in your book on page 324. That's a loan factor chart. It looks intimidating, and luckily for you, you only have to memorize half of it. You don't have to memorize any of it. The test will have the loan factor chart on the question. Okay? And they actually make it really simple for you because they only give you a little small snippet of a loan factor chart. So you only have to look for a small section. Just real quickly, can you find what the monthly payment is going to be on a 15-year loan at 6% interest? 8.44. Does everybody see that? You find that on the chart. Because if you can't find that on the chart, we need to fix that right away. Did everybody find that with no problem? Payment over a 15-year loan at 6% interest is $8.44 per what? Per 1,000. So if I was borrowing $150,000, what would I do with that $8.44 in order to calculate my payment? Multiply it by 150, because that's the number of thousands that I borrowed. If somebody was doing that loan and they gave me that hypothetical question of, okay, well this house is $220 and that one's $230, how much would my payment go up? What would I do? Multiply that $8.44 by 10, because that's the amount their loan would go up, so therefore that's how much their payment would go up. So let's get real world with it. Today's interest rates are 3.75% on a 30-year fixed rate loan. Find me that loan factor. It ain't even on there, right? You can't even find it. You can't even find it because the charts don't go that low. Isn't that funny that the numbers they put in the books don't even go as low? But they do go all the way up to 10 1/4 down there, or 10 3/4 down there. So in case that ever happens, you can do that. But let's just pretend we're at the lowest number on your chart, 4%. What is the loan factor for a 30-year note at 4% interest? 478. So if you wanted to give your client some quick math for how much their payment would change, because this isn't something you would discuss when you're making an offer. Sometimes you need to break it down to them as a factor of payment, because they get stuck on numbers, right? They get stuck on it. They get hung up on it. You know, well, I'm offering them 150. I'm not offering them anymore. Okay, well, they counter-offered with 152. I'm not paying $2,000 more for that property. Well, would you pay $10 more a month? Where am I getting that $10 more a month from? From $4.78. I'm just rounding up to $5. Because at $4.78, isn't it pretty close to $5? And they're borrowing an extra $2,000, so it's going to be $10 a month. It's actually going to be more like $9.50 a month extra. You see how that's helpful to be able to present it to a client in that way when you get down to a negotiation where they're really close on numbers? Because you can just, that's sort of like a reality check for them, you know? It's not $2,000 to you, it's $9.50. And they're like, oh, okay. It's amazing the difference it makes. That's the power of the loan factor, you know? So, you should always be able to calculate a payment amount, principal and interest payment, by reading a loan factor chart. So, okay, so wrapping up chapter 14, we worked our way through the secondary mortgage market. We've worked our way through the different types of government-backed loans, conventional loans. We talked about qualifying borrowers and debt-to-income ratios. We talked about loan factors. On page 327 in your book, we get into some finance regulations that you need to be familiar with. And these are very heavily tested on the national section of the license exam. So you need to be real familiar with this section and make sure you understand these finance rules because they're very important for the test. Okay? The first one that we talk about is the Truth in Lending Act. Okay? The Truth in Lending Act, and in particular, Regulation Z of the Truth in Lending Act. So let's first talk about what the Truth in Lending Act is. The Truth in Lending Act is designed to protect borrowers. Anytime you're borrowing money in the U.S., the Truth in Lending Act is in effect. That means it's in effect for home purchases, it's in effect for car finances, it's in effect for car leases, it's in effect for credit cards. Anytime money is being loaned, the Truth in Lending Act comes into play. Now, we particularly care about Regulation Z, as in zebra, of the Truth in Lending Act. That's part of the Truth in Lending Act. Regulation Z is the one that we're most likely to encounter in the Truth in Lending Act. It says Regulation Z applies when credit is extended to individuals for personal, family, or household uses and when the amount of credit is $25,000 or less. Regardless of the amount, Regulation Z always applies when a credit transaction is secured by a residence. So, anytime the debt is for less than $25,000 and for household purposes, Regulation Z is in effect, or anytime a residence is used as collateral. That sounds a lot like a mortgage to me, doesn't it, for you guys? So anytime there's a mortgage in play, Regulation Z is in play. Regulation Z requires the disclosure of all of the terms of a loan whenever we cross over into advertising finance. Well, obviously you guys aren't in class to become lenders, so you're not going to really be advertising finance, or are you? That's the real question. The real question is, are you advertising finance? So when you are advertising finance, Regulation Z says that you have to disclose 4 things about that loan. Okay? 4 things about the loan that you have to disclose. And I backed up a slide to show you what those 4 things are. The 4 things are the APR, and you need to know these 4 things. The total amount of all the finance charges, the total number of the payments and how much each payment is going to be. So in a 30-year mortgage, what's the total number of the payments? 360 payments of this amount, for example. And the total amount that's going to be financed. So anytime you're advertising financing, whether you're a lender or a real estate broker, if you advertise financing, you've got to disclose all of this information about the loan that you're advertising. When might real estate brokers, you think, advertise financing?
When they're like 0 down.
Yeah, that's what Leanne said, and it's the perfect answer. When we say 0 down, we put a sign in front of a house, own this property, 0 down. Well, we're not only advertising the property now, but we're advertising what?
Financing.
Some kind of financing, because obviously if you're putting 0 down, there's a pretty hefty loan involved somewhere in that. Does that make sense for you guys? So that's how we cross the line from advertising property into advertising finance. And that's what Regulation Z is all about. Regulation Z is about where the line is. How far can we go and not be considered advertising finance?
So if we just change the wording, right?
We could change the wording, because Regulation Z sets up something called trigger terms. And I want you to put that in your notes. Regulation Z sets up something called trigger terms. And in this, the simplest way to explain to you what a trigger term is, and it's on page 328, is that a trigger term is a number. It's a number related to a loan. Now, obviously, there are numbers we can advertise that are not trigger terms. Is the purchase price of the property a trigger term?
No.
No, because it's not related to a loan. Is the square footage of the property a trigger term?
No.
No, because it's not related to the finance. Is 0 down a trigger term?
Yeah.
Yes, because it's a number, and it's related to what?
Financing.
Some kind of financing. Is own this house from $8.95 a month? Is that a trigger term?
Yes.
Yes, because it relates to a loan. How much do I have to put down? How much do I have to finance? How long am I financing it? What's the interest rate? Those are all the questions that pop to mind if you tell me I can own this house from $8.95 a month. And guess what those questions are? They're the things you have to disclose. What do we say the 4 things you would have to disclose if you put that sign out there that says own this house for $8.95 a month?
APR.
The APR, so the interest rate,
Total amount.
the total amount financed, right? The total finance charges, and the number of payments and how much each payment is. That make sense? So if you give them, here's the long and short of it. You can't give a tiny glimpse of the loan. If you're going to talk about the loan at all, you've got to give them the full picture of the loan.
Can you say those one more time?
The 4 things: the annual percentage rate, the total finance charges, so things like the origination fees and all those kinds of things. Okay? So the APR, the total finance charges, the total number of payments and the amount of each payment, and then the total amount that you're financing. So what would the principal balance of the loan be? Those are the 4
If you just
things.
said no money down, you wouldn't have to do all of that.
Exactly. If I say something like no money down, that's not a trigger term, because no is not a number.
Oh, that's if you say 0.
But if I say 0 down, 0 is a number. If I say low monthly payments, is that a trigger term?
No.
But if I say payments from $8.95, is that a trigger term?
Yes.
Yes. So the smart real estate broker will not use what?
Trigger terms.
Numbers, trigger terms, because that makes us do a lot of extra work. If I put a sign out front that says 100% financing available, do I have to disclose what that loan looks like? Yeah, because 100% is a trigger term. But if I put a sign out there that says no down payment required, or USDA finance available, are either one of those trigger terms?
No.
No. Good, good. And that's according to what regulation?
Z.
Z of what act? The Truth in Lending Act. Good, good. Okay? And if you look on page 328, penalties for violating Regulation Z, $10,000 for each day the violation continues. So you put a sign out there that says, 0 down, and you don't have the rest of that information, you could theoretically be fined $10,000 a day for every day that sign is out there.
So does the sign have to say all 4 things? If that's-
Something has to say all 4 things. So you could have a flyer out there, for example. As long as there's some additional information that's readily accessible wherever you've given that trigger term.
Okay.
Yeah. So generally speaking, what I would do and what I would recommend, if you're going to have something like that on your sign, like, 100% financing available or 0 down payment required, have a lender that's a partner of yours that you work with, work you up a worksheet for that loan and put that worksheet in a box on the sign. Because that worksheet's going to have all that information on it. Okay? The Equal Credit Opportunity Act, which is also on page 328, is another law that governs real estate financing that we have to worry about, or at least be aware of. The Equal Credit Opportunity Act creates protections for borrowers. Okay? We're going to talk later in the class about fair housing rules. Fair housing sets up certain protected classes of people that you can't discriminate against. The Equal Credit Opportunity Act also sets up certain classes of people that you cannot discriminate against. Okay? So now I'm going to give you the ones that you need to worry about with the Equal Credit Opportunity Act. This is not the only people that are protected under the Equal Credit Opportunity Act, but here's how you should think of it. It's everything that's in fair housing plus these groups right here. Age. Age is a protected class under the Equal Credit Opportunity Act. What that means is that I can't deny a loan because of someone's what?
Age.
Age.
No matter how old they are.
No matter how old they
You
are.
can take a 30-year loan out when you're 100 years old.
That's exactly right. I've had a closing with people that were in their 80s and took out 30-year mortgages. It's kind of laughable if you think about it, but you can't deny it on the basis of
But you
age.
can make them have a mortgage insurance policy.
You can, absolutely, because that has to deal with their ability to repay. You cannot deny somebody credit on the basis of their marital status. So what should that tell you about age and marital status as it relates to fair housing? Since I said these are the only 2 that are fair housing plus everything else. What does that tell you about age and marital status as far as fair housing? You think they're protected?
No.
They are not protected in fair housing. You can discriminate on the basis of age in fair housing law. You can say, I will not sell you my house because you're too old. That is entirely legal in this country because it's not a protected class under fair housing. But you can't deny somebody a loan on the basis of age. Okay? The Fair Credit Reporting Act, or the Fair Isaac Act, sometimes as it's known, basically gives individuals the right to check their credit at least once a year for free. You are entitled to your credit report at least once a year from each of the 3 credit bureaus for free. And you can call them or write to them, and they're required to give it to you at least once a year for free. There are obviously certain other services you can subscribe to where you can get it more often than that. The North Carolina Predatory Lending Act, which is on page 329. The Predatory Lending Act basically is there to protect consumers against lenders who might take advantage of them. Okay? And basically, you just need to know that North Carolina has a law that's designed to prevent people from being taken advantage of, particularly in real estate transactions. Okay? You don't need to know the specifics of it. You just need to be aware of the Predatory Lending Act. You do need to know the Real Estate Settlement Procedures Act on the bottom of page 329. RESPA. We're going to talk a lot about RESPA in chapter 15, so we're not going to go any further than to just introduce it here. But the name of the law is the Real Estate Settlement Procedures Act. Another, settlement is another word for what?
Closing,
Closing. So what does this law govern?
loans,
The
As
closing.
loans and the what of loans? The
closing.
closing process of loans. The Real Estate Settlement Procedures Act sets up all the rules for closing a loan. What's the name of Chapter 15?
Settlement.
Closing the transaction. So is Chapter 15 going to have a lot to do with RESPA? Yes, absolutely. And you do need to know that RESPA stands for Real Estate Settlement Procedures Act.